cash equity trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom McKenzie.
And here are your top stories.
Not the week, well, and the week. The Hang Seng, as Tom points out, up by 3.1%. And this really to do with better mood music between China and the US. How long does that last? A focus on the dollar against the yen. The yen actually pulling back from earlier weakness. 148.88 is where we trade. Nasdaq futures suggest we'll go a little higher today in the US session. That after the moves of yesterday focused on the tech sector. And here's the story we've been talking about a lot this morning. The very long end of the US curve. The 30-year yield at 4.69%. In today's session, we're seeing some buying of those Treasury products and those yields coming down, but that has not been the story of September, Tom.
European futures pointed to gains of around 0.6% over in Germany. You snapped 5 days of losses yesterday to post a gain across European equities. Looking to build on that today, Anna.
Yeah, absolutely. So looking to build on that. Futures are pointing higher. What does that mean for the start of the European trading day? Let's load up the GMM screen for you and show you where we go. Expectations that we will see some of those stocks then go higher this morning. The FTSE 100 out of the gates first, up by 0.2%. But generally speaking, flying in the face of all the September news flow and all of the September sentiment in markets, it seems that we're pretty risk on today. So we're buying stocks. We're definitely selling the dollar index, the Bloomberg dollar index, down by 0.3%. The euro gains, the pound gains, the Swiss franc certainly gains. And we're also buying sovereign bonds. So we're buying stocks and sovereign bonds. This is not the September that we have known. This is just the end of September. Maybe some month-end rebalancing, quarter-end rebalancing, of course, we were talking about with Eddie van der Velde earlier on. We're also seeing a little bit of movement out of some of those commodities, and sometimes those risk-on days, expectations about better things out of China. Sometimes that sends those commodities higher. We're not seeing that across the board. Certainly we're taking a break from the rally in Brent crude. $95 on the nose, though, so certainly not talking about low oil prices by any stretch. This is what we see then in stocks. As I mentioned, the FTSE 100 out of the gates higher, but only modestly so. The French CAC 40 up by around 0.5% this morning. Tom, what do you see on the sectors?
Well, to your point, this is a mirror image of the broader picture across September, because you're seeing energy as a sector lower. Of course, energy and oil prices have risen across the month of September, and that has raised concerns about inflation. But the sector currently down 0.3% because Brent and WTI both taking a bit of a breather in terms of the run-up in those prices. And technology, which has been badly hit, of course, the growth story has run out of steam. But today, tech is rallying as a sector. You combine that, of course, with the yields coming in slightly lower, at least so far in the session, and a little bit of relief. The upside, of course, came through from those Nasdaq big players, the big tech names, the likes of Meta posted some decent gains in the US session yesterday. So there's that read across as well. Tech gaining 1.3%. Energy is down 3%. The consumer part of the sector as well, part of the equity complex, is gaining a full 2%. So one of the biggest leaders coming through there. Retail also doing well. The lift may be coming through in terms of the read across to Nike. They've managed to deal with those inventory levels. They've actually seen EPS coming in, earnings per share coming in better than many had expected. Retail then getting a bit of a lift, maybe from the Nike story stateside. 1.3% is the gain there. Financial services also up 0.8%. Travel and leisure, that has been challenged as well by some of the gaming companies, but also the higher yield environment. But today, adding gains of about 0.8%. And food also in positive territory. Across the benchmark, then, gains of 0.5%, Anna.
OK, now let's get to Sam Unstead from our Markets Today blog, who joins us once again on set. And Sam, lots to talk about this morning. I know we want to get to the commodities story, and I know we want to get to sports, because there's news, and why not? So we'll do that in a moment. But firstly, on the broader market sentiment, the point Tom and I have been making this morning, today, just as Tom said, looks like a mirror image of September, doesn't it? I mean, I guess we don't read too much into today's moves, given given we are at the end of the month and the quarter?
Yeah, well, that's right. So as you said earlier, it's not only the end of the week, it is very much the end of the month and very much the end of the quarter. And I think we saw a little bit of this yesterday. So everyone is kind of rebalancing, hedging, making new bets all at the same time. And so some of the moves you're going to see over the course of the next day or so, certainly over the course of today's trading day, may not totally always make sense when you're trying to put them all together. But if you take it in that context, that after what has been quite a challenging quarter, people are trying to bet on what's going to happen in the rest of the year.
Help us make sense. In the UK, basic resources have benefited from this, the tick up in iron ore prices. But help us make sense of why that price increase is coming through, given that almost on a daily basis we get another news item reminding us of the property crisis in China. You can't have a strong demand for iron ore without strong demand for property. How are you linking the two then?
Yeah, that's a good point. But actually, what you're starting to see, very, very incrementally, is a little bit of positive news. And when it has been so negative for such a long period of time, and you're right, like I've come on this show so many times with new incremental bits of negative data out of China, you get to a certain point where anything is going to be grasped onto, and you've got the economic data coming over the weekend. The expectation is it will be a little bit better, and so at the moment with this rebalancing, there's maybe a little bit of a bet that perhaps China is turning a little bit of a corner.
Okay, now for the promised sports conversation, Sam. So we're seeing the owners of various sports clubs actually raising money through various activities. What are we focused on here?
Yes, we have Chelsea yesterday. It's actually a Bloomberg scoop that they are raising another £250 million. And then Liverpool's owners are also selling a stake in the club as well. I think the interesting part of this is actually the US involvement. So huge amount of US interest in the Premier League in particular. And it feels as though over the course of the last few years, investors in that country have seen the Premier League as the next really big place that they can go and invest that will emulate what they've seen with, franchises like the NFL.
The search for yield, as it was referred to, until we got yields on treasuries, and maybe that changes things.
Except football clubs never make money, do they? Almost never make money. But you do have this rush, US money and Middle East money. That seems to be where the drivers are coming through. Russian money, of course, that's been sidelined. But it is really fascinating in terms of how this evolves. Sam Munster, thank you very much indeed from our Markets Today blog. And of course, you can get more from Sam and the rest of the team by typing TLive Go on the terminal. Here's what else we are watching today. At 10 a.m. UK time, we're due to get a prelim reading of Italian CPI for September. That's going to be interesting given the divergence you've seen between the Spanish inflation data that came in slightly hotter than expected versus the fall that we've seen for Germany and France. So whether Italy follows the trend that we've seen in Germany and France, of course, will be consequential, or whether you see a bit of a surprise as we did in Spain. At the same time, we're also going to get the full euro area inflation print, so that's going to round out the picture for us and give us a bit more clarity on where the ECB has to go from here. And at 1:30 p.m. UK time, we're going to get that US PCE data that is due, and we know that the Fed scrutinises that, Anna.
Yeah, really interesting then. We had Germany, their CPI prints coming in lower than expected. Yep. The French have picked up with that baton this morning, the same theme coming through, so inflation coming in. So that's good for the ECB. It's getting them closer to their target on inflation. Doesn't say great things about the growth story, but it does tell you that maybe we are at the terminal rate for the ECB. But yet the euro goes higher. It just seems this risk-on mood we're seeing in markets today seems to be overriding all other things, as if we're just really trying to put September behind us.
Are we trying to look at it through the Goldilocks prism of inflation coming down just enough to give the ECB pause, bake in that pause, maybe pull forward your view on rate cuts? It was really interesting to speak to Marcello Cavallo of BNP, who said, look, very clearly, the Eurozone is now in stagflation. He expects a couple of quarters of very, very soggy growth.
Yeah, absolutely. So we'll watch that. Let me tell you what is coming up on the programme. A new report outlines diverging growth patterns in former Eastern Bloc countries. We'll be speaking to the EBRD's chief economist, the European Bank for Reconstruction and Development, focused initially on Eastern Europe and beyond. We'll talk about that next. This is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
This is Bloomberg. This is Markets Today. We are just coming up to 10 minutes into the European trading day, and it's looking pretty positive, actually, up by around 0.6% on the Stoxx 600 this morning. Let's get to some individual stocks that are on the move, because there's the overall risk sentiment, but there's also the individual news lines. Joe Easton has a briefing from our equities team. Joe.
So we're seeing some clear green on these sports stocks at the moment, Anna, after Nike jumps 8% in the post-market after hours yesterday, following that earnings beats, lifting Adidas and Puma, and also JD Sports, one of their biggest retail partners, not only here in the UK, but also in the US. And there was a bit of concern around a slowdown in US sales heading into this, following reports from Foot Locker and also Dick's Sporting Goods, which sent these shares lower. But as I say, seeing some clear rises then. We've also thrown in Brunello Cucinelli is in the clothing space as well, not sportswear, but luxury clothing. Adding in there is Goldman Sachs. Double O upgrades that one to buy. They say demand for cashmere sweaters is holding up, and they recommend clients buy into that one. So clearly green on the clothing today. In terms of the German stocks, Commerzbank outperforming, up 7% as they announced they will return 3 billion euros to shareholders in the coming years, more than analysts were expecting, even though they are having to set aside a bit more cash to keep regulators happy. Now, the other two, you'll have to trust me, they are more interesting than they look. ThyssenKrupp down 0.3%, but that was the best performer in Europe yesterday. It spiked at the close of trading on news that they're potentially selling a stake in their steel business for the Czech billionaire Daniel Krasinski. He wants to buy a stake in that. West Ham fans will know him as their biggest shareholder. He's also, well, he's got a stake in irons and steel. There's a bit of a joke there, just thought of that one. But anyway, Synlab, now ticking unchanged now, but Synlab, this has got a takeover offer at 10 euros a share, but it's been suspended by the regulator, but it's trading at 8 euros at the close yesterday. So clearly there is upside. When that one opens, it should move higher. Now, finally, on the UK water company, Severn Trent, raising £1 billion worth of capital, easing some concerns around its debt. That one rising 3%. And Aston Martin jumping after Lawrence Stroll increases his stake in the company by another 3%. He's the billionaire that took over that company, put it into Formula One. His son drives one of the cars. Very interesting story there. Just Eat we've got because there was a negative ruling in New York around minimum wage payments for delivery drivers, but analysts seem to have expected that one, and it's ticking higher. Finally, Fever-Tree Drinks. Gin and tonic is Friday. Everyone's going to be going for a G&T, and Fever-Tree Drinks is higher after a Danish investor takes a stake. That was unexpected, a 5% holding. I had a quick look at them, not too much info on who they are, but it's pushing that one higher, around 5% at the moment.
Joe Easton, comprehensive. Thank you very much indeed. Setting us up for the weekend very nicely. From our equity team, we appreciate it, Joe, with a breakdown of some of the stocks on the move. Now, a new report from the European Bank for Reconstruction and Development is forecasting a diverging growth pattern in former Eastern Bloc countries. The report sees high energy prices and persistent inflation weighing on the outlook. However, increased Russian trade and remittances is boosting the economies of Central Asia and the Caucasus. Joining us now is Beata Javoric, who is the chief economist at the European Bank for Reconstruction and Development. Beata, thanks for joining us this morning. Where is this divergence most pronounced and what is behind it?
Well, good morning. Thank you for having me. Well, it is a difficult year for Central Europe and the Baltics. The region has shifted into lower gear, growing at about 0.5%. Now, these countries are much poorer than Western Europe, so they should be growing faster than that. Of course, what's weighing on their performance is weakness in Germany. Many of these countries are very reliant on the German market. And then household budgets have been eroded by inflation in the region higher than in Western Europe. And uncertainty, geographic proximity to the war means greater uncertainty, less investment. And that's in contrast to Central.
Okay, apologies. That's in contrast to other areas where different metrics then apply. Let me just ask you about parts of Eastern Europe, though, where inflation is still high, and think about interest rates. Are there areas where you think interest rates are not sufficiently restrictive to bring down inflation? There's talk of political influence in certain areas. Are you focused on that theme?
Well, we don't focus on inflation per se, but certainly markets were surprised by the three-quarter lowering of interest rates in Poland, and exchange rate markets reacted to that. And that lowering of interest rate contrasted very much with careful language, for instance, from the ECB. I think we are not quite out of the woods with inflation. So the sudden move could actually prolong the disinflation process.
Where are the bright spots then in this economy, this part of the European economy?
I'm sorry, could you say it again?
I'm just going to ask, the inflation is clearly a challenge, and as you say, the growth picture is looking sluggish, but where are the bright spots, if there are any, for some of these Eastern European nations?
Well, tourism is a bright spot. As everybody was suffering from inflation, countries in Western Balkans, Albania, for instance, have recorded a record number of tourists. As a cheaper destination, they actually did very well. And similarly, Southern Europe also did well in terms of tourism. Though, of course, concerns are emerging now about desire of people to travel weakening. So it will remain to be seen how these countries will do later in terms of tourism.
Beata, you also focus on Ukraine, of course, and the devastation there, the loss of human lives, of course, the focus really. But from an economic perspective, you think about the amount of support that Ukraine is getting. Do you see that? Are you assuming that that support is maintained, that it will continue to get debt relief and other kinds of financial assistance from the West? And what are you focused on in terms of reconstruction? How can you have conversations around reconstruction when the war still rages?
Well, let me start by saying that maintaining macroeconomic stability has been one of the big achievements of the Ukrainian government. And that has been possible thanks to the IMF program and thanks to official flows, including flows from my institution, the EBRD, that have alleviated pressure on the currency and help with the fiscal situation. Also, Ukraine saw inflation at the order of 27% last December. By now, it's actually inflation is in single digits. So I think this macroeconomic stability should not be underappreciated because it makes life as bearable as possible for people, preventing further outflows of refugees. And of course, Ukraine needs the human capital for the reconstruction phase.
So the importance around the macroeconomic picture and the relative stability that's been achieved there by policymakers. Look, I know you're the chief economist, Beata, but do you have a sense to what extent is the EBRD and other multinational institutions going to be getting involved in the reconstruction? Where are we in that process? Has it started already?
So at the moment, we are focusing on supporting the Ukrainian economy. We committed to invest 3 billion euros between last year and this year, and we are on track to deliver that. We are supporting repairs to infrastructure, international trade, agricultural sector, and of course, private firms. I think it is absolutely crucial to revive the private sector. And then looking forward, we are part of the discussions on war insurance. I think it is pretty clear that reconstruction will require flows from private investors, and in order to enable that, they need some form of insurance.
Yeah, certainly a focus. Can I ask you about the changing role of Russia in some of the areas of focus for the EBRD? Some are suggesting that what we've seen recently in Nagorno-Karabakh, as a result of Russia being very focused in its operations, its war in Ukraine, and less focused on other parts of its former area of influence. From an economic perspective, how has the changing role of Russia had an impact?
Everybody has been surprised by somewhat strong performance of Russia in terms of economics, right? Russia is growing at 1.5%. So they are prioritizing macroeconomic stability over growth. I think we've seen sanctions in terms of price cap not working as well as we thought. So Russia has been able to have fairly loose fiscal policy. And of course, they are very focused on the war, and we are quite concerned about the situation in the Caucasus countries, and we are hoping for a peaceful resolution of the conflict there.
Beata, thank you so much. Thanks for joining us on the program. Beata Javorczyk, the chief economist at the European Bank for Reconstruction and Development. Coming up on the program, the countdown to a shutdown of the government in the United States. What to expect with time running out for a deal over US debt. That's next. This is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customers like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is the national debt clock. It's been in New York since the late 80s, and it shows the gross national debt that we as a nation owe countries, companies, and people that lent us money.
The U.S. routinely is spending more than the country and the government is taking in. So we are living beyond our means.
By the end of this decade, the U.S. is set to spend more each year paying interest on its national debt than it will on national defense.
This hasn't escaped the eyes of our U.S. credit rating agencies.
Many worry that a confluence of factors is going to send the U.S. into a debt spiral.
And you can watch more on America's looming debt spiral on Bloomberg.com and, of course, on your Bloomberg terminal. Now, the deadline to avert a U.S. government shutdown, and it all ties in, of course, is fast approaching. House Republicans have just released a stopgap bill, but a last-minute deal is not likely. Let's get the context then with Bloomberg's senior editor, Bill Ferries. Bill, get us up to speed on what has been happening in Washington, D.C., and whether or not we are now facing the inevitable.
Well, I think we're just under 45 hours before that potential shutdown hits. We have seen some new proposals from the Republicans. It's unlikely to lead to any kind of a breakthrough. Right now, the negotiators on the House side have not been coordinating any of their efforts with the negotiators on the Senate side. So any legislation that comes out from either chamber would have to be worked through the other. That's just very unlikely to happen in the limited time we have left. So most likely what happens is we start Sunday morning with the U.S. government shutdown, and how long it goes may depend on how quickly some of the political pressure ratchets up and how willing Kevin McCarthy is to put his speakership at risk to broker a deal that would include Democrats.
And so how long this lasts will then have an impact, well, if we get there, and how long it lasts, Bill, will have an impact on the impact that it has on the U.S. economy. But just paint a picture for those who need reminding of what happens when the U.S. government shuts down. What are the kind of things that do happen and don't happen when this takes place?
Well, there's going to be some essential services, things like military deployments, the Postal Service, senior officials. They will continue to work. That will continue to operate. Social Security, Medicare checks, those will continue to go out. But the vast majority of the federal workforce who don't fall into those categories will not be allowed to work. They'll be told to stay home, not to go in. That includes fairly senior people at places like the White House. So a huge swath of the federal government will shut down. There's annually 12 appropriation bills. Those have not been voted on. Those have not passed. And until that happens, either one by one or in one massive piece of legislation, the federal government will not restart, until there is some kind of a deal.
Okay, that political impasse pushing us closer, it seems, to another shutdown from the U.S. government. Bloomberg's Bill Ferries with the context. We appreciate it. And Anna, it is remarkable, isn't it? We're talking about hundreds of thousands of people potentially not getting a paycheck. We're talking about SpaceX as well as an example of one of the contractors for the U.S. government. So the impacts are huge, and we're talking about the economic drag potentially coming through on that economy.
Yeah, the economic drag and then the subsequent rebound when it opens up. That could be interesting in the political context, our colleagues tell us. Coming up on the programme.
BlackRock CEO Larry Fink from the Berlin Global Dialogue sitting down with Danny Berger. Do not miss that interview. That is next. This is Bloomberg.
that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Markets Today, 30 minutes into your European trading day. Let's get to your headlines. Wake me up when September ends. U.S. stocks head for their biggest monthly loss this year. The bond sell-off deepens with yields on 30-year treasuries on track for the largest quarterly jump since 2009. CPI surprise, French inflation unexpectedly slows, adding to a divergent picture across Europe. We get Italian and Euro area data later on this morning. Plus, showdown weekend. The U.S. government shutdown draws ever closer as over in Detroit, the UAW plans to expand its car plant strike if progress is not made on those talks. So, Tom, September so awful for anyone long of stocks, long of bonds. We've seen yields much higher and a lot of angst in the markets. Today looks really different. We've seen some of those yields coming down and stocks bouncing.
I'm just thinking of that analogy or that example of if an alien was to land on Earth today and have a look at things, they'd think, okay, these markets are looking okay. The data's looking okay. Inflation's coming down. Equity markets are rallying 0.9%. There's optimism over in China. A smashing session over in Hong Kong on expectations you're going to get a big spend coming through from the Golden Week holiday. Expectations that maybe the two presidents will meet in November, that the geopolitics is starting to thaw. You have the inflation data out of France, building on the picture we got out of Germany, coming in lower than expected. Yes, Spain is out there as a divergent picture with higher than expected. And we get Italy later today. The UK economy, by the way, looking more resilient than many expected as well. The GDP print coming in slightly stronger than expected. So this is the picture across these European markets. Again, just such a reversal from what we've seen in terms of the picture this month and this quarter. Is it going to be sustained is the key question. 0.9% across European equities, building on the gains that we saw yesterday, and we'll break down the sectors shortly. But the DAX is up 104 points, adding 0.7%. Here in the UK, the FTSE 100 looking back to those 7,700 levels, adding 56 points, up 0.7%. Let's have a look at the sectors then. The last time I checked, it was only energy that was lower. And that is good news, of course, broadly when it comes to the inflation fight. But the context is you've had a 30% run-up or so for Brent since about middle of June. But today, prices coming in a little bit. The other big story, of course, is the softer dollar. That is playing into more positive sentiment, and then the move into bonds as well. So energy just down 0.1%. The big gains coming through from consumer products. The lift in terms of the sentiment from Nike, and that is certainly lifting some of their big competitors in the European space, and an upgrade as well for the luxury, one of the luxury names coming through from Goldman Sachs, lifting what's happening for consumer. 2.4%, look at that, steaming ahead in terms of the sector gains. Technology up almost 2%, retail gaining 1.3%, food also up, and that is the picture. Utilities gaining after some losses in the last few days, adding 1.3%. Basic resources also up. Sam Unstead breaking down the picture for us. Iron ore and copper gaining on the back of a little bit of optimism around China. That sector adding 1.3%, but it's consumer that is leading the pack so far in the session today, with the broader picture of gains of 1%, Anna.
Okay, now with the deadline, Tom, for the US government shutdown approaching, let's take a look at how markets are positioned for that prospect. Bloomberg's Valerie Teitel with us. And Valerie, has it been surprising how markets have reacted or not reacted in the run-up to what looks like a shutdown over the weekend?
Well, Anna, these political events are always very difficult for the markets to price in. But one thing I want to say is the big driver for an eventual market reaction would be the length of this government shutdown. We know the longest government shutdown lasted just over 30 days. So we have no idea whether we're in for a few days or possibly a whole month of a shutdown. And that's really going to drive what the impact is on GDP and perhaps the Fed reaction to it. If we do get more Fed members talking about the possible risk to GDP when it comes to this government shutdown, it could actually lead to an equity market rally if the front end of the bond market takes that as the Fed is less likely to hike this year because of these effects. If we look at how the S&P 500 has performed during recent government shutdowns, it does tend to outperform, at least in the last few examples we have seen S&P outperformance. A lot of that, I guess, is driven by the fact that it's really hard to tighten policy one more step further if there is more uncertainty around growth on the horizon. And Anna, it's not just the government shutdown that the Fed has to contend with. It's also the auto strikes that are ongoing as well, that possible hit to GDP. We have heard from many Fed members this week talking about the uncertainty around these events, these uncertainty around how the U.S. economic growth will fare in the fourth quarter because of these two issues on the horizon.
Valerie, is there a temptation, maybe that's what we're seeing in the bond markets today, to look at bad news as good news in terms of possibly pulling forward cuts from the Federal Reserve, given the challenges around the strikes, given this government shutdown? You're seeing yields lower across the curve today. To what extent are the markets starting to think about that as a possible scenario?
Well, look, it's a big sense of relief for markets to see that we finally might have a global bond rally on our hands this Friday morning. It is looking good so far with treasuries, gilts, and bunds all looking lower in yield on the day. But yes, you're right to that extent, Tom. If this does, I guess, make the Fed waver on their language about what will possibly be needed in terms of hikes in the fourth quarter, if we start to hear more Fed members talk about how it's unlikely that they would hike into this economic uncertainty, you could see a further bond rally, a further equity rally. Maybe we bounce from just how bad September has been for these assets. And you're looking there at the big number on screen. That was the move in the 30-year yield yesterday. It crossed 4.8% for the first time since 2010. And that is really what's been catching markets' eye this month. But if these headwinds from the government shutdown, from the strikes, really start to bite, we could see a big reversal when it comes to October.
Okay, and give us a brief sense then, Valerie, of the global implications of what we've been seeing at the long end of the Treasury curve, because this hasn't just been affecting Treasuries, of course. This has been kind of hijacking the narrative on global bonds.
Definitely. I mean, this Treasury route has really led to a big repricing, not just for Treasuries, but for global yields as well. Take Germany, for example. We had the 10-year yield in Germany hit highs not seen since 2011. And then overnight, we have to talk about JGBs. They are just reaching ever higher in yield. We had the 10-year yield, the 20-year yield, and the 30-year yield in just the last two sessions breach decade highs that we have not seen since 2013. This Treasury pressure is really causing other assets to gyrate, I guess, off the back of it. The big question is, Anna, what is going to cause this sell-off to pause? And perhaps this government shutdown maybe could be the good thing on the horizon if we do see a bond rally off the back of it.
Yeah, you touched on Japan, 148.54 on the yen now. It's actually a gain of 0.5% despite that surprise bond buy by the BOJ. Softer dollar, no doubt, a factor there. Bloomberg's Valerie Teitel with the latest. Thank you. This is Bloomberg.
was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Markets Today. We are 40 minutes into our European trading day. We can see that European equity markets are trading higher this morning, up by 1% almost on the Stoxx 600, the FTSE 100 up by 0.8%. And we've said it many times, but it's worth underscoring, Tom, just because of the extent of the risk on that we're seeing in markets this morning. It does feel as if the markets, I mean, maybe we ignore all of this because it is the end of the quarter and it's the end of the month and the week and everything else. Well, the end of the quarter, most notably. But maybe, therefore, we don't read too much into it. But there's such positivity driven by not much. Or is it just the end of the quarter that we're seeing here, you know, because the equity market moves, sovereign bond moves, all flying in the face of the themes of September.
Yeah, and you look, US futures are pointing to gains as well of around between 0.4 and 0.6%. But the context, as you say, is that US stocks are still set for their worst month of the year. But the moves on the dollar, I think, really important. So the dollar down 0.4% on the Bloomberg Dollar Index. That's getting a bit of relief to currencies like the yen. We've been on 150 watch, of course. You're currently on 148. It's actually a gain of 0.5% for the Japanese yen after that surprise bond buy. You're also seeing yields, as you touched on as well, coming in across the curve in the US, but also in the Eurozone. Most pronounced on BTPs. We've been focused on the Italian budget deficit question and concerns there, but currently yields at the front end in Italy, currently down 7 basis points at just 4.03% on the 2.
Right, and that's in keeping with the global theme, isn't it? Yeah. We've been taking our lead from Treasuries, and we continue to do so. So Treasuries, yields on Treasuries going so much higher in September has been such a big theme, particularly at the 30-year. And today we see a little break from that theme, and Italy in keeping with that. Worth just going through a couple of the superlatives, I suppose. 10-year US yields, highest since 2007. 30-year yield in the US, highest since 2010. And as we've been saying, we were talking about it with Valerie, it hasn't just stayed in the US, this Treasuries theme. German yields on the 10-year, highest since 2011. Japan, 30-year, highest since 2013. This has become a global September phenomenon.
And in gilts yesterday, you saw a sell-off to the point where yields were up about 20 basis points. They're coming in a little bit today, between 2 and 4 basis points across the curve. Arguably, what happened yesterday with gilts was a bit of catch-up. Again, across the equity markets, gains of a little over 0.9%. Let's cross over to Berlin now, though, the Global Dialogue Forum, where Bloomberg's Danny Berger is hosting a panel, The Global Economy in Times of Fragmentation. Let's listen in to Danny Berger and her conversation with BlackRock's CEO, Larry Fink.
The markets go up and down, markets move, markets respond to political issues, political uncertainties. But I would clearly say we are in a period of time with these mega cycles, we're in a period of time with so many transitions. Whether it's a transition from deflation to inflation, a geopolitical transition, and where does that go? The fragmentation of supply chains is just beginning. we have policies in so many democracies that have moved from policies that I would say were embedded for more deflation, and now policies are more embedded in inflation.
Well, as we adjust to that, you have Jamie Dimon, for example, saying rates in the U.S. could go to 7%, and we're not ready for it. Is he right?
Look, we all have opinions. I mean, I've been saying for over a year.
I want to know your opinion, Larry.
My opinion is we're going to have 10-year rates at least at 5% or higher because of this embedded inflation. This structural inflation is unlike anything. And I think business leaders and politicians are not providing the foundation to help explain this. We have not seen inflation like this in over 30 years. Actually, I was a young bond trader during the late 70s and where we had hyperinflation. I don't think we're going to have anything close to this inflation of the 70s, but we have so much deeper structural inflation, and we are underestimating the change in geopolitics is so structurally inflationary. When I was in Davos earlier this year, I heard the phrase national security uttered everywhere. And quite frankly, I never heard those phrases uttered that often before that in all my years. So national security for chips or food or energy, obviously energy, and all these issues. And the question is at what cost? And nobody answers that question, at what cost?
Well, you said politicians, governments, they need to do a better job of explaining this, of talking. What would that actually look like?
Well, I mean, they have to recognize if we are going to focus on the whole idea about restricting immigration. Big topic here in Germany. Big topic in the United States. We are down in the United States close to 3 million legal immigrants. We've changed the immigration policy. At the same time, there's so many job needs. And in the United States, we've had close to $1 trillion of fiscal stimulus just beginning its J-curve. And these are huge job creators. And at the same time, we have restricted immigration. And as a result of it, we see more wage pressure. So at what cost? We have, in the United States, a very protracted strike between the auto workers and the auto companies. It has been reported that the union is asking for a 40% increase. So at what cost? What, in the long run, what does that mean for jobs? Do more jobs move? This is the conversation we're having now. We are, because of the invasion of Ukraine and the realization in Europe, especially here in Germany, of the dependency in Russian gas, every boardroom is asking themselves, where are our other dependencies?
Yes, but...
And the dependency in China in terms of manufacturing assembly is something that many companies have said we cannot.
Does there need to be leadership, though, to reinvigorate multilateralism? Or is that concept, because in this era of friendshoring, reshoring, is that over? Do we need to rethink that?
Well, globalization is still intact. It's just being reimagined. So whether we have our supply chains out of China, now we're moving them to Vietnam, Philippines, Eastern Europe, Turkey, India. Mexico is one of the real destinations for North American demand. And so this is not global. By no means globalization is over. But as we reimagine these supply chains, there's a reason why so many supply chains were so embedded in China, because that, for years and years and years, was the cheapest, easiest place to do it. And so in many cases, we're moving supply chains at higher costs.
Yes, especially if you're onshoring to either Europe or the U.S., where you're having these labor conversations.
But you may have, all of this means is we're going to be more aggressively moving towards technology to add more productivity, whether it is using more robotics, AI. All of this is going to, in the long run, that's what I'm saying. Markets go up and down. We have big changes. We have big changes in labor. We have higher wages. In the long run, companies adapt, businesses adapt.
Right.
But the biggest issue for me, and I say this to every governmental leader I see worldwide, what the world is missing today is hope. I see more fear than any time in my business career.
What are you hopeful about, Larry? What is that hope?
Look, I'm a long-term optimist, and we build BlackRock on optimism. We are the largest retirement manager in the world. Okay, why on earth anybody would ever put their savings into something that may have a 30-year outcome? My gosh, that is optimism. Okay, if you're not optimistic that 30 years hence is a better outcome, you're going to keep all your money in a bank. But Danny, what's going on in China is a great example of fear. Before COVID, the Chinese, who are unbelievable savers, they saved 35% of disposable income. 35%. Think about that. Now, they did it because there's no safety nets of healthcare like we have here in Germany, no safety nets of retirement, one-child family, all these dynamic issues. During COVID and the fear and the lockdowns and the changes of policies, savings rates in China right now are 50%. And that's fear.
And they're struggling to reinvigorate the economy at this point.
Because they're frightened.
But what does that look like on the ground for the investors in the crown? You at BlackRock, how do you look at this? Is there a way to capitalize on it? Do you pull back? What do you do with a problem like this?
Right now, I think in our mega trend said, right now we are under-invested in China. We believe structurally until we see savings rates, which is in my mind, when we see savings rates decline and they're consuming more, that's an indication of more hope. That they don't need to save as much, that they can consume, they can do other things. To me, these are very big macro trends. But I just want to say the biggest issue is we as business leaders, we as political leaders, if we don't provide more certainty and more hope, this is what causes recessions. This is what causes pullbacks.
So to be clear, because there are a lot of calls of a recession, hard landing, soft landing, no landing. They've all lost their meaning at this point. Let's be honest. So in this era of fear, of no hope, are we headed for recession right now?
Well, there's not no hope. It's all, I'm hopeful.
Let's hope. Larry's hopeful. We're happy about that. But does that mean we are headed for a recession right now?
So I think we have to analyze that by each region, because the United States, our home mortgage market is based on a 30-year mortgage. So anybody who has a home mortgage, higher interest rates does not impact them. And so the transmission of high elevated interest rates in the U.S. takes much longer to impact the economy. Whereas in other places where you have more floating rate, or like in the United Kingdom where you have generally a 5-year fixed and then it resets. And then, so let's assume 20% of the mortgages have to be, reevaluated at a higher level. That creates more immediacy at higher rates. So I think we're going to see some economies enter recessions early.
Which ones would that be?
Well, I think Europe
is anyone's more sensitive to
the ones that are more sensitive to this elevated interest rates, and you're starting to see a real decline in GDP and other. They're basically flat now, but can they go into a more protracted recession? Whatever the recessions we're going to have, they're going to be quite modest. So I'm not even that fearful. But the other issue.
I have a stat for
let me just say one thing, Danny.
Yes, then I'll inject the fear.
But I believe if we have labor shortages, if getting back to this whole social issue of how are we going to be doing this, in many areas you may need a recession to bring down labor demand. And I think this is one of the things that's going to impact in the United States. You still have a very vibrant economy. The United States, and as I said, the J-curve of the Infrastructure Act, the CHIPS Act, the IRA, which has huge implications, that's going to be creating jobs. And so it may require a more protracted Federal Reserve, and it may mean by 2025, the United States economy may be entering a recession, but I don't see it any time in the near term.
So throughout history of U.S. growth slowdowns, we have underestimated every single one of them. Are you confident we're not making that same mistake again?
Look, if central banks can overshoot, if fear becomes worse, then consumers pull back and the recessions are going to become more protracted. We have elections in so many places of the world. We have an election in the United States. We have all that stuff. You know, we are going to have many political candidates who are going to provide a lot of fear,
yes,
unfortunately. And I think the political winner is the one who provides the most hope for the future, or what people believe the hope in the future.
Do you see that, though? Do you see anyone projecting hope?
I dearly hope so. I'm projecting hope.
Larry for president? I don't know.
No, I'm too young.
That is that is very true. Look, you make an excellent point. I think half of the population is going to be in an election next year.
Yeah.
Could we then have a recession based on what you're saying, not by a monetary accident, but by a fiscal accident?
So in my travels seeing governmental leaders, I talk about the need for more public-private investing, whether it is in infrastructure, sustainability, whatever you want to say, power grids. What I see is most democracies are having elevated fiscal deficits. I worry about it. I think it's going to be a crisis in the future. I believe we are hitting thresholds of just too much debt. The only solution we have now is reorienting, reimagining how we finance growth. And I think the way we're going to be able to finance growth is public-private. There's so much private money that is looking for great long-term investments to work, whether that is in power grids or infrastructure, in sustainability, charging stations, you name it. You know, and so in all our conversations is how can we reimagine finance? How can we find a better structure, and how can we then leverage public finance with private capital to augment growth?
Right.
And this is going to be the big key for the next 10 years.
Can I ask about how you're thinking about that at BlackRock? Because you're already the world's largest asset manager. So what is your goal now?
Look, our goal is to provide a better financial future for more human beings. All our money is not a single euro dollar is our money. 100% of our money is our clients' money. We have to do what our clients are looking to do. And I think we are a really good fiduciary, that we work really well with our clients. We give them long-term views. When they ask me what's going on in the market, I really don't have a good answer because I don't really care about.
That was Bloomberg's Annie Berger speaking to BlackRock CEO Larry Fink. You can continue watching the rest of that conversation. A really fascinating one there. Live go on the Bloomberg terminal if you want to access that conversation, coming to us still from Berlin. Fragmentation of the supply chain just beginning, he said. Geopolitical change is so structurally inflationary, really tapping into some of the long-term themes that we've been talking about in markets as we've seen rates on the rise through September. He says he's projecting hope. He says politicians will be successful if they project hope, although he doesn't sound like he's hurrying into politics just yet. Elevated fiscal deficits also part of that conversation. That is it for markets today. You can get more insights from us and the team. Front page of the Bloomberg UK website will take you to the Markets Today blog. You can type TLIV go onto the Bloomberg terminal to find that blog. European stocks go higher in defiance of the themes of September as we get to quarter-end rebalancing. US futures higher. This is Bloomberg.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. Here's what's coming up on today's program. A diverging picture across Europe as French inflation expectedly slows. Euro area CPI is up later this morning, the next piece in the puzzle for the ECB. Now the BOJ announcing an unscheduled bond buying operation after yields across the curve climb to decade highs around the world. Plus, deadline weekend, the U.S. government shutdown draws ever closer, while over in Detroit, the UAW could expand its strike against the legacy automakers. So a quick look at the European markets map as we really digest some of these cross currents you are seeing from around the world. But look, green on the screen across the board. But I wouldn't say a ton of momentum unless, of course, you do look at, say, the DAX, for example, higher by 0.7%. Now, look, a lot of the global stock market has been under quite a bit of pressure. So it's really no surprise you're going to see this kind of return into the equity market. And by the way, that is something you are seeing around the world for the last 3 Fridays, which I think is pretty counter to trend. Simply this idea that on Fridays, people usually cash out, go home, spend their weekend, revisit on Monday. Now we're seeing a different dynamic at play. That's the equity picture. Let's talk about the bond picture as well, because look, the treasury sell-off around the world is really, really interesting, specifically when we look at JGBs, but also when we look at U.S. treasuries. And there's an argument to be made that as we start to look at some of the spreads between Italian BTPs and German bunds, a lot of the price action is actually driven by the sell-off you are seeing in the U.S. And I think this chart really encompasses that theme well, because if you go out into maturities, the 10-year, the 30-year, that is where we are. The highest, by the way, going all the way back to not 2008, not 2007, but 2006, when we're talking about that potential housing bubble. And that is going to be crucial. Now, what are the ripple effects, especially when it comes to allocation? That's where we bring in the S&P 500, having their worst month yet of the year. Now, this makes a lot of sense. A 10% correction in the tech index, 7.2% from its peak in July. It only makes sense that you are now seeing a lot of the momentum come out of the market. Now, the big winners of that rally that we just saw are actually the ones taking the hits. But I think it's still pretty important to say, look, this is, at the end of the day, a technical correction that you are seeing in the market. And that is significant because it then incentivizes new money to enter the market after people think the sell-off is actually done. One part of the market that is not seeing that dynamic this morning is going to be in the sports sector. And again, as we digest all the geopolitics, we decide the monetary policy, earnings are starting to seep back in as well. Now, overnight in the U.S. session, we did get Nike numbers. They basically said, look, the inventory glut that we had, it is over. The margin story that we had, it's over. In fact, we're actually beating beating our estimates and having major profit in a way no one really expected, to the point that you're starting to see a lot of the green on screen flow into a lot of the European names as well. Adidas, or Adidas, as I'm told it's pronounced, Puma as well, and JD Sports, all higher by, we'll call it about 6% on the day. That is very significant in terms of the global approach to retailers that have largely been hit in the last couple of years. So, of course, that's going to be a cross-asset story from around the world. I want to bring you some new analysis, some new data. Eurozone inflation figures hitting the terminal at about 10 a.m. London time today. We've already had surprise with the French CPI data this morning. Joining us now for more on this is Bloomberg European correspondent Maria Tadeo. Maria, what can we expect from Eurozone inflation reading today, and how key is it to the ECB's next rate decision?
Look, it's always important, and as you say, we are in countdown mode to that piece of data, which should hit in about an hour from now. And Kriti, we've had numbers from Germany, we've had numbers from France, which show inflation effect cooling for the month. That's also reflected in some of the core dynamics. So that trend should continue when it comes to the euro area number. In fact, economists now expect that number could be in the 4% handle. However, the outlier, and I want to pay attention to this, has been Spanish CPI. Of course, when you look at the numbers that we got yesterday out of Madrid, you saw that headline inflation actually ticked up. And a lot of that is reflected in an increase in the volatility that we see in the energy market. When you look at some of the data from the Bank of Spain, but also the Spanish stats office, they say it really reflects that pickup in fuel. And the reason why I want to take my time from Spain is not that obviously this is my country and I pay attention to it, but it's also the dynamics that could affect headline inflation because of energy prices do pose another layer of complexity and another headache for the European Central Bank. Remember, they have been very focused on core inflation, but they target headline inflation, and that is the volatility that the head of the European Central Bank already alluded to, given the complex picture that we see on energy prices in Europe. Now, when it comes to the monetary policy, Kriti, you know very well the market is positioned now mostly to this idea that the European Central Bank is done hiking and now we flip into higher for longer. So that is maintaining rates at a high level. The numbers from Spain, you could argue, do back that case. But I should point the head of the ECB, of course, Madame Lagarde, is already insisting, however, keep an open mind because both duration and level matters to the European Central Bank. As you know, they will meet at the end of October in Athens for another monetary policy decision.
A lot to digest for the ECB. Bloomberg's Maria Tadeo breaking it all down for us. I love the idea that Spain could be the canary in the coal mine for the broader continent. Let's explore that topic a little bit more. Joining me now is Catherine Nice, Chief European Economist and Deputy Head of Global Economics at PGIM Fixed Income. Catherine, a pleasure to have you with me this morning. Look, it kind of feels like there's some counteracting forces here. Maria just talked about inflation coming down in the Eurozone. We know it's coming down in the United States and other parts of the world. Perhaps not the pace that we wanted, but it is coming down. And yet, you are seeing a massive sell-off in the Treasury market right now. Yields hitting multi-decades high around the world. Why?
So I think there's a difference here between what we're seeing in inflation, which is largely reflecting what's happened in the past. So these are these much earlier rises in energy prices that we saw finally working their way through core inflation. And that's why because of these base effects that we're expecting core inflation now in the euro area to come off. But it's very much a backward-looking picture. As Maria noted, we're seeing higher energy prices now. That could be affecting headline, but it's going to affect things like core and services price inflation with a lag. So what does that mean? Yes, on the one hand, some comfort that we're finally seeing core and services price inflation coming off in the euro area. But against a backdrop of ever-rising energy prices, I think there is an expectation here that that fall down over the course of 2024 could happen very, very slowly, very, very gradually, and mean that this higher for longer expectation actually gets realized.
Well, how does that then apply to the Bank of England then? It feels like they have a completely different set of expectations and almost a set of I don't want to say tools, but I want to say impact, I think, is a good way to put it. You used to be a member of the Bank of England yourself. Talk to us about how you apply what you just said specifically to this country.
Well, I think we have to remember that each of the central banks do have slightly different remits. They're all inflation-targeting central banks when we talk about the Fed, the ECB, the Bank of England, but they do have different remits. The ECB is really very focused primarily on price stability, whereas the Fed, of course, has a dual mandate. And I would say the Bank of England is probably somewhere in between. They are an inflation-targeting central bank. They remind us of that at every meeting, but it's always subject to supporting the government's economic policies. And I think they do have more of an eye on the macroeconomy in the UK. And the UK economy is visibly weakening. It's also facing perhaps more structural headwinds than what we're seeing in the euro area. And perhaps that is a factor behind their decision to hold at this point. And of course, rates, they did start raising rates much earlier than the ECB, and they're at levels that are higher than in the euro area. And so I think for them, they really want to wait and see, how does the UK macroeconomy pan out? What does that mean for underlying inflation for the UK going forward?
You know, we were joking last week that we always call Jay Powell the central banker to the world, and maybe Andrew Bailey should take that title, just given that he has been the first mover in so many different ways. Talk to us a little bit about the liquidity picture, though, because it feels like even though there are all these fundamental narratives, perhaps the idea of supply digestion, isn't being fully kind of rinsed out or fleshed out. Walk us through your take on the liquidity picture.
So I think this is a really great point, because you know, we sort of feel like we're kind of near peak rate. Based on what we know now, we think that central banks are largely done. The bulk of these interest rates are behind us, higher for longer. Does that mean that we can sort of think monetary policy is on autopilot? I would say no. There are other bits of the central banking toolkit that could take on more prominence in the months to come, even against a backdrop where rates aren't changing very much. And we're seeing that, for example, in the Bank of England, where they're doing accelerated balance sheet runoff. There are rumors that perhaps the ECB is thinking about bringing forward the end of, PEP reinvestment. So all of this could create some bumps along the road as we continue to transition towards more normal monetary policy. And I think that's something that, we shouldn't lose sight of.
I think that's a good way to put it. Bumps along the road in terms of deciding the direction of the broader market. Well, Catherine Nice, Chief European Economist at PGIM Fixed Income, stays with us. We still have more of her brain to pick coming up on the program. House Republicans release a stopgap bill as the U.S. government shutdown gets even closer. That story next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
Wall Street is waking up. Europe is already trading. And Manus Granny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. take a daily deep dive into risk, and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for. They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
The deadline to avert a U.S. government shutdown is fast approaching. House Republicans have just released a stopgap bill, but a last-minute deal isn't looking likely. Joining me now is Bloomberg's Derek Wallbank, joining us from Singapore on this topic. Derek, you've had decades of experience covering U.S. politics. Talk to us a little bit about what this bill might actually entail.
Yeah, so I've had a chance to read it. It's about 180 pages long. The headline of it, I would say, is very, very, very steep cuts to everything that Democrats hold dear in a government budgeting sense. If you sort of, Republicans have tried to take some things that they like off the table, say we wouldn't cut defense, we wouldn't cut Veterans Affairs, we wouldn't cut Homeland Security, border, things like that, wouldn't cut disaster aid. Other than that, 29.88% cut. Democrats aren't going to go for that. I mean, it's not rocket science me saying that to you. Democrats aren't going to go from that. And indeed, this bill wasn't crafted with Democrats in mind. The point of it is to try and get something on the board to increase the leverage position. This is exactly the same playbook that House Speaker Kevin McCarthy ran during the debt limit situation. Try and put something up, find that improves your leveraging position, go from there. Problem is he might not have the votes. Now, we're expecting House Rules Committee to take up the way that this bill will be considered, the rule for this bill, at 8 o'clock in the morning, Washington time. Expecting votes somewhere around the 11 o'clock to 1 o'clock window, also Washington time. So for those of you who are watching in Europe, you'll see towards the end of your day kind of where this is looking at and what our weekend is looking for. Asia's going to wake up tomorrow and figure all of this out and sort of see where we are. But all signs sort of point right now to the idea that as Saturday turns into Sunday in Washington, we may have a red headline on the wire that says that there's been a funding lapse.
Where is the pain point here? Who actually gets hit? Who goes home?
Yeah, I think that your biggest pain point immediately is federal workers, especially the ones who are being told that they have to continue working without pay and we'll catch you up later, possibly. That, I think, is a pain point. But I also think that there's some other pain points. I mean, one that I would mention is some of the labor statistics that are being kept. You know, it's harder to do that. Who's essential, who's not. That's a potential pain point that you could see. I think the biggest one that's kind of overhanging over all of this is a sort of, I don't know if we'd call it a threat, more an observation from Moody's. Moody's is the only one of the big three rating agencies that has the U.S. at AAA at the highest, and they said that a government shutdown could be potentially negative for the U.S. because it would demonstrate that maybe it's got some governance issues that need to be worked through. And so if you saw that change, then you're talking about some potential difficulties there. Yeah. The longer this goes on, though, the political pressure increases. I think right now it's important, though, to consider Kevin McCarthy probably has the votes to extend government funding if he wants to put that bill on the floor. He's probably got the votes for it. But if he does that, he's going to catch so much mess from his right flank that he might have a problem holding on to his job. That's a fundamental conflict.
And to your point, he certainly has a lot to prove both within and outside his party. Bloomberg's Derek Wallbank, thank you for that update this morning. We still have with us Catherine Nice, Chief European Economist at PGIM Fixed Income. She sticks with us here. Let me put to you what Derek just brought up. Moody's came out right in front, I believe at this time last week, actually, and said, if there is a government shutdown, there's a real chance of a downgrade. The last time we heard something like that from its peers was in 2011, and it ended up creating this massive kind of influx into the bond market. Do we see a repeat of that come Monday if the government does indeed shut down?
Potentially, that's the sort of safe haven flows, as you say, that we've seen in the past. I think, looking at it from a European lens, it feels a little bit like deja vu. We've been here before. And I guess we can't forget, though, that the U.S. is an extremely important trading partner for the euro area. I think the good news is that generally when we've had this sort of experience in the past, the hit to U.S. Real GDP in the quarter that the shutdown happens tends to get recouped in the quarter that follows. So that's the good news. The bad news, as you were pointing out, is this reputation risk. And of course, it comes on the back of other kind of down-to-the-wire decision-making that we're seeing from U.S. policymakers, definitely more fragmentation across political parties. But I think more importantly, what is this potentially a signal around, fiscal, the fiscal risks in the U.S. economy? And this could potentially have big spillover implications, I think, for the euro area. That is certainly, one to watch.
In terms of the kind of transparency issue that we may foresee, this idea that we may not get payrolls numbers, we may not get the data that we need, everything gets delayed and pushed back further. How big of an issue is that from an investor point of view?
Of course, it's never good to be flying blind if you're a policymaker, and events are fast moving. That said, the fact that it's happening at just this moment in time, when policymakers are signaling, for now the bulk of the interest rate rises are behind us. Now we sort of need to pause, see how the macroeconomy is adjusting to these higher rates in order to assess where next. Perhaps this delay is not going to be as bad as it might otherwise be, given that we are a little bit in a wait-and-see position. But obviously, policymakers are having to make really important judgments as it is, and so at the margin, this is not helping.
Well, from a political perspective, it feels like this is being closely watched in terms of the players, simply because of a kind of early indicator of how even 2024 and the election might play out. In the bond market, is it too early to start pricing in some of the changes and developments going into next year's election?
Well, bond markets are very forward-looking, so I don't think it's too early, and there will be judgments that need to be made about a range of scenarios. And I think that is one of the real difficulties right now, is that you can see two quite plausible scenarios at opposite ends of the spectrum when it comes to what that means for the bond market. It could be that this wall of pain from higher interest rate rises is just about to hit. I'm thinking in particular in the euro area, and these hints of weakness are really going to start to gather pace quite quickly, versus a scenario where actually governments are still supportive. We're seeing a lot of unspent investment money that was agreed during the pandemic, both in Europe and in the U.S., and that should help to underpin some of the cyclical weakness. So things could kind of go either way, and once you average those two things out, that sort of leaves you in the base case, which is we are where we are, and we're probably going to stay here for quite some time, unless things start to evolve in a very different way going from here.
Yeah, and it looks like that volatility really going to get amped up. I think we showed a chart that shows shutdowns are met with volatility anyway in the bond market, at least for a little bit. Catherine Nice, Chief European Economist and Deputy Head of Global Economics over at PGIM Fixed Income. We thank you for your analysis this morning. Coming up on the program later this hour, we'll hear more from BlackRock CEO Larry Fink after the Berlin Global Dialogue. We get his prediction on whether the U.S. economy will indeed enter a recession or have a soft landing. Stick with us. More ahead. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now for some of our other top stories. Credit Suisse may report an additional losses of as much as $2.2 billion in the third quarter. That's according to the defunct bank's financial report for the first half of the year. Investors remaining optimistic about UBS's capacity to successfully integrate its former rival. Bank shares poised for their best quarterly share price gain in 14 years. Staying with European banks, Commerzbank says it intends to return a total of €3 billion to shareholders in the 3 financial years to 2024. This comes as the German lender details its long-awaited capital return strategy. Coming up on the program, we look ahead to today's Eurozone CPI data due this morning and focus in on Germany after inflation there sank to its lowest level in 2 years. Stick with us. This is Bloomberg.
Connection lost.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The name themes that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
A diverging picture across Europe as French inflation unexpectedly slows. Euro area CPI is up later this morning, the next piece in the puzzle for the ECB. Now the BOJ announces an unscheduled bond buying operation after yields across the curve climb to decade highs. Plus, it's deadline weekend. The U.S. government shutdown draws ever closer, while over in Detroit, the UAW could expand its strike against its legacy automakers. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Now, German Chancellor Olaf Scholz is downplaying fears of a potential trade war over the EU's anti-subsidy investigation into Chinese EVs. He spoke exclusively with Bloomberg at the Berlin Global Dialogue.
The economic model which I favor is to have a global competition. I'm very much in favor of globalization. I think it made it that billions of people left poverty, that many came up to middle class in many countries of the world, that many new cities had been built and will be built, and that we see new highways, new railways over the world, airports, hospitals, universities, schools, all these spreading up all over the globe, and this is a good thing. Our task must be that this is not just a part of the world, even if it's a big part, that our task must be to work for the whole world to participate from the chances of globalization and to grow and to have their own infrastructure and industrialization and things like that. And this would be also a much safer world, to say it. But the economic model, let's say, of Germany, but I think it is model that fits for the whole world, is that we are not working protectionists. We want to sell, to say it, our cars in Europe, in North America, in Japan, in China, in Africa, in South America, in all the places. But this means that we are open to get the cars of other countries also on the market of Germany. And I still remember, what was it, the big debates that started when the Japanese cars came to Germany. Well, they are part of the market, and there is now German cars in Japan and Japanese cars in Germany. What is the problem? And the same happened when the Korean became successful car producer, competitive on the whole world. They're doing a good job, and now there are German cars in Korea and Korean cars in Germany. What is the problem? And we should look on these things like this. It is the better alternative than the protectionist way.
German Chancellor Olaf Scholz speaking exclusively to Bloomberg. We have an euro area CPI data hitting the terminal at 10 a.m. London time today after a reading of French inflation showed an unexpected cooling earlier this morning. Now, focusing on Europe's largest economy, Germany's inflation numbers actually dropped to its lowest level in 2 years, softening far more than expected. Bloomberg's Oliver Crook in Berlin is all over that story. Ollie, good news or bad news?
Yeah, well, a bit of both, I suppose. It shows that inflation is coming down, which is obviously good news for the ECB. This is sort of the intended effect. 4.3% is quite a bit better than the 6.4% we had the month before. That is in part because of the base effect from last September, where you saw inflation really jump up after the subsidy for transport in Germany was evaporated. The downside, though, is, of course, that this shows that the economy is perhaps slowing a little bit. And when you look at the risks going forward, you look at the energy sector. We've done 30% on oil in the last 3 months, but really also taking a look at gas as we enter winter. This is a key concern for Germany. And remember, there's still 25% of the original amount of Russian gas flowing into Europe that has not yet been cut off. And this is sort of something to keep in the back of your mind. And then also thinking about labor in Germany. So structurally, you have problems in the labor market here in Germany where you don't have really enough workers. But in the shorter term, IFO is saying that companies are starting to be a bit more reticent around hiring. So maybe some of that slowing of labor demand and perhaps will dampen wages a little bit as we enter the end of the year.
So a lot of doom and gloom coming out of Germany. Does that make them the sick man of Europe?
Well, this is the big question, right? This was a sort of economist cover, and this is a big conversation here in Germany, and we talked to a lot of executives about this. And there's a bit of a mixed picture on that. Obviously, in the short term, there's the question of manufacturing. It's 20% of the economy here, and that has really seen a very strong slowdown in recent months, and the last, really since July of last year, and been in contraction. And it's expected to shrink this year, Germany's by 0.6%, which is even worse than they thought earlier in the year. So all of that is pointing toward the downturn. Again, looking forward towards catalysts, one of the things that we're paying close attention to is China. Could this EV trade war escalate into something more severe? And how are German executives thinking about this? So I spoke to the CEO of Siemens Health, the CEO of Siemens Healthineers yesterday about the difference between de-risking and decoupling.
China is a huge opportunity for us. What is important is that the rest of the business, being able to deliver or being able to live up to the expectations of customers in the rest of the world, outside China, doesn't depend on China. So that's for me the topic, and we have also worked on decoupling, so to say, the supply chain, but we are extremely committed to further investing in China.
And so really highlighting how important this market will remain for this company, China that is, but really also trying to pull the supply chain out of it and try to insulate that a little bit. The other thing, Grady, that we might want to pay attention to, speaking to these German executives, a lot of them are saying, and you're not going to find this in the price discovery, part of the issue here, the doom and gloom, is that Germans can be quite pessimistic and a bit self-deprecating, and a lot of these economic surveys are about sentiment, not necessarily hard data.
Pessimistic and self-deprecating. It's almost like you're in London. Oliver Crook in Berlin joining us this morning. We thank you. I'm going to stick with the story in Germany. Let's get to the Berlin Global Dialogue Forum, where Bloomberg's Danny Berger hosted a panel called The Global Economy in Times of Fragmentation. She had a great conversation with BlackRock CEO Larry Fink. Take a listen.
I don't know what is a new normal. I actually think every day is normal. The markets go up and down, markets move, markets respond to political issues, political uncertainties. But I would clearly say we are in a period of time with these mega cycles, we're in a period of time with so many transitions. Whether it's a transition from deflation to inflation, a geopolitical transition, and where does that go? The fragmentation of supply chains is just beginning. We have policies in so many democracies that have moved from policies that I would say were embedded for more deflation, and now policies are more embedded in inflation.
Well, as we adjust to that, you have Jamie Dimon, for example, saying rates in the U.S. could go to 7%, and we're not ready for it. Is he right?
Look, we all have opinions. I mean, I've been saying for over a year.
I want to know your opinion, Larry.
My opinion is we're going to have 10-year rates at least at 5% or higher because of this embedded inflation. This structural inflation is unlike anything. And I think business leaders and politicians are not providing the foundation to help explain this. We have not seen inflation like this in over 30 years. Actually, I was a young bond trader during the late 70s and where we had hyperinflation. I don't think we're going to have anything close to this inflation of the 70s, but we have so much deeper structural inflation, and we are underestimating the change in geopolitics is so structurally inflationary. When I was in Davos earlier this year, I heard the phrase national security uttered everywhere. And quite frankly, I never heard those phrases uttered that often before that in all my years. So national security for chips or food or energy, obviously energy, and all these issues. And the question is, at what cost? And nobody answers that question, at what cost?
Well, you said politicians, governments, they need to do a better job of explaining this, of talking. What would that actually look like?
Well, I mean, they have to recognize if we are going to focus on the whole idea about restricting immigration. Big topic here in Germany, big topic in the United States. We are down in the United States close to 3 million legal immigrants. We've changed the immigration policy. At the same time, there's so many job needs. And in the United States, we've had close to $1 trillion of fiscal stimulus just beginning its J-curve. And these are huge job creators. And at the same time, we have restricted immigration. And as a result of it, we see more wage pressure. So at what cost? We have, in the United States, a very protracted strike between the auto workers and the auto companies. It has been reported that the union is asking for a 40% increase. So at what cost?
Bloomberg's Danny Berger there with BlackRock CEO Larry Fink making some really interesting comments about the bond market and the state of the entire U.S. economy. I want to get back to one of the major movers on the Eurostock 600. That, of course, is Commerzbank. Those shares higher by about 10.3% this morning. The German lender saying it intends to return a total of 3 billion euros to shareholders in the 3 financial years to 2024. This as Commerzbank details its long-awaited capital returns strategy. So classic buyback pushes the stock up kind of announcement. Coming up on the program, striking auto workers in the United States say they want a 30% pay rise from Detroit's 3 major car makers. That story next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now, the United Auto Workers Union is saying they want a 30% pay rise from its strike action at Detroit's 3 major automakers. Joining me now is Bloomberg's Bill Ferries. Bill, this saga has been going on for so long. Are we any closer to a breakthrough?
Well, the hard answer is maybe. We'll get a lot more information from Sean Fain, the president of the United Auto Workers, when he is expected to speak at 10 a.m. Eastern Time in the United States. But we have seen some progress in the sense that, the UAW's latest ask is they say that they want at least a 30% salary increase for their workers. That is down from, I think, an initial ask of about 40%. And we know Ford had come in at one point proposing 20% plus cost of living adjustments and other things. So the gap, I think, between the two sides has narrowed. But today will be a key moment to see if that strike in its 3rd week now expands to even more plants.
So the initially came out, I think the very first offer that they had was about 46% pay raise. And look, this isn't immediate. This is over the course of several years. But what is the latest proposal? How much farther lower from 46% are we talking?
So we're at 30%, but that's really seen, I think, by the UAW and its leadership as a floor. They want to see the big 3 companies continue to raise what they're willing to pay. And look at other adjustments. It's not just about the basic salary. This is about plans for future plants, EV plants. It's about retiree benefits. There are a lot of other issues in there. The union is really looking for progress on all those fronts. But when it comes to a bottom line number on wages, they say it has to be at least 30%.
So what happens then today? Like, what is our worst case scenario? How does this play out?
Well, I think there's a couple things. We'll hear from Sean Fain, the president, at 10 a.m. We'll find out if some talks that were happening late Wednesday, Thursday, if there's been any progress in those talks. We'll also find out whether there's continuing progress with Ford. Ford, as you remember, was left out from the latest escalation of the strike. If there hasn't been progress, if you're talking about a worst case scenario, the UAW could say, you know what, we're putting Ford back on the table. We're going to increase the number of Ford facilities that are facing strikes, and we're going to increase the number of strikes at Stellantis and General Motors facilities. So I think that's the worst case. Is you see progress talks breaking down, and workers at more plants, more auto facilities hitting the picket line.
Certainly a lot to digest. And I wonder what precedent they end up setting for the future labor movements that I'm sure are in the pipeline. Bloomberg's Bill Ferries, thank you for the update this morning. I'm going to stick with a major story that, of course, the U.S. government is watching. The recent debut of Huawei's high-end smartphone. Well, it could be a message to the United States that its tech curbs aren't really doing much to stop China from developing advanced semiconductors. At least that's the subject of today's Big Take piece. Let's get a little bit more with our Asia Technology Executive Editor, Peter Elstrom, joining me this morning. Peter, how big of a deal is this new piece of technology?
Hi, good morning. To understand the significance of this new phone that Huawei put out, it helps to go back a few years. Huawei is a very secretive Chinese company that a couple decades ago emerged as a very big player in telecom equipment. So they were competing with the likes of Ericsson and Cisco, and they very quickly became the biggest player in telecommunications equipment. And then after that, they went into the mobile phone business, and again, they grew very quickly and they surpassed the biggest companies, Samsung and Apple, to become the biggest player in mobile phones. So the United States did two things that really wiped out their smartphone business. First, in 2019, the U.S. blacklisted Huawei, cutting them off from some of the key components that they needed. And then last year, in 2022, the Biden administration implemented a whole series of export controls that limited the kind of semiconductors that could be sent into China and the kind of semiconductor equipment that could be sold into China. So when Huawei came out with this new phone, the Mate 60 Pro, in late August, it was not just the return of Huawei to the smartphone business, it's also a signal that China is much more advanced in semiconductors than many people had realized.
Well, expand on that there. Talk to us a little bit for the folks who aren't really ingrained in the nitty-gritty of the chip world, what the SMIC chip actually is. Why do we care?
Yeah, so this SMIC is the Chinese company that actually made this chip for Huawei. And what the United States tried to do in October of last year to set up controls around the Chinese semiconductor industry, which is sort of the foundation of the technology industry, so that it could not get as advanced, it could not get close to the sophistication that you see in the US or other countries around the world. The goal was to hold China back to about 8 to 10 years behind where the United States was. And when we saw this latest chip in the Huawei phone from SMIC, it turns out that they now appear to be about 4 or 5 years behind where the U.S. is. Now, there are a lot of questions still remaining. It's not clear whether SMIC can make these chips in volume. It's not clear exactly how broadly they're going to go within the economy. Nobody really cares about whether advanced chips are going into smartphones. If there are sophisticated smartphones in China, that's not the big deal. The big issue is whether these chips can then be used in applications like artificial intelligence or supercomputing, and especially military applications.
I mean, it's a fascinating dynamic because, of course, as you're seeing these technological advances, I mean, there's healthy competition on the one side, and then there's the geopolitics between the United States and China. Peter Elstrom, our executive editor for Asia Technology, breaking that crucial story down for our European audience. We thank you for joining us this morning. Coming up, we go right back into the markets. The S&P 500 heading for its worst month since December of last year. Valerie Teitel has your markets wrap next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. I want to get a quick recap of some of the major market movers on the Euro Stock 600 today. A lot of them coming from Nike's earnings overnight in the U.S. session. Simply the idea that Adidas, Puma, JD Sports taking their cue, I suppose, from Nike's massive profit beat. They're basically saying that, look, the inventory issues of the last 2 years is getting a little bit easier, putting a little bit of growth on the margin story, where something that, retailers around the world have felt a lot of pressure for. That's just one story we're going to be following in the session. The others has to do with the global equity picture. Having been rocked this month, the bond market not really pretty either. Let's get a little bit more on the markets with Bloomberg's Valerie Teitel. Valerie.
Oh, look, that's exactly it, Kriti. It's been a big month, not just for the equity market, but for fixed income markets as well. For the S&P 500, we are headed for the worst month of the year. The S&P index is down some 4.6% this month, on track for its worst month since December 2022, all down to this rout that we've seen in treasuries. In my next chart, we can zoom in on just how big it was. In the 10-year and in the 30-year yield, both of these rose over 50 basis points in September alone. This has really been the key to what's driven the dollar strength, to what's driven these equities to be in the red for the month of September. I've got a circle here on August 1st. That was when the U.S. Treasury first announced their larger auction sizes and that we were issuing nearly $1 trillion of treasuries this quarter. You can see we've been nearly on a one-way track for higher yields, lower bond prices since that extra supply was announced to the market. But it's not been only in the Treasury market. We've had a global repricing when it's come to yields. Not only have treasuries hit cycle highs across the curve, but we've also seen German 10-year yields be rocked as well, hit the highest levels since 2011. We also saw that spread widening happen between Germany and Italian debt as well. And then over in Asia, we need to mention what's been going on there. The 10-year, the 20-year, and the 30-year all rose to decade highs. And if we actually look on Japan on a quarterly basis, they have had the worst rout in JGBs in 25 years, Kriti. It's been a monumental quarter for the bond market, for treasuries, for Euro govies, and for gilts, and for Japanese bonds as well.
A lot to digest there. And of course, as we know, the shutdown is looming. That always creates a little bit of volatility in the bond market, even if it is short-lived. Bloomberg's Valerie Teitel, we thank you as always. Now, if there's bond volatility, the first thing that comes to mind is simply that the idea that some of the banks may actually profit off that volatility. When speaking of those banks, Commerzbank is the biggest riser on the Euro Stock 600 this morning. The German lender says it intends to return a total of 3 billion euros to shareholders in the 3 financial years to 2024. This as they give long-awaited details on their capital return strategy. Now, looking ahead to Monday, we'll speak exclusively to JP Morgan CEO Jamie Dimon. He is here in town for a tech summit. You do not want to miss it. Up next for now, the Bloomberg Brief. Danny Berger in Berlin, Manus Cranny in New York. This is Bloomberg.
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lyons.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Cranny. Danny Berger in Berlin today, where she's speaking to the BlackRock CEO, Larry Fink. Welcome to Bloomberg Brief. Let's set the agenda. The clock ticks down closer to the deadline. The U.S. shutdown appears all but inevitable. Kevin McCarthy continues to struggle to get the hardline Republicans on board. The demand comes clear from UAW. Auto workers want at least a 30% pay rise from Ford, GM, and Stellantis. The prospect of a resolution may help investor sentiment. And the BOJ announces an unscheduled bomb buying operation after yields cross the curve, climb to decade highs. Let's begin with the breaking news. We're on inflation watch globally, but to Europe first of all. The euro area inflation is crossing the wire. Maria has the numbers. Maria, take it away.
Yes, Manus, and look, what we see is a significant drop in inflation in the euro area in September, both on a headline basis, but also the core number. This is the number, Manus, that really matters. Euro area core inflation in September now is at 4.5% on a year-on-year basis. So you see now that both are in the 4% handle. Now, Manus, overall, what this means is that the European Central Bank and the market is very well positioned for this. Now has a case to say, maybe let's take a breather and pause. Remember, the market does believe that there won't be more hikes. It is a question of higher for longer. If you look at the data here, both on a core, but also on a headline basis, you see a significant drop in inflation in September, now 4% handle, but also that core number, that is very significant. It does show that this monetary policy is really feeding into now the real economy.
And will that kick in to peak ECB as the differential between them and the Fed is what's driving the ultimate alpha of the dollar and the drop on the euro. Euro dollar at the moment is trading at 106.05. So you have this particular non-reaction. A lot of it is already in the price. The presumption of a rollover in inflation down 2% on the month, down 3.2% over the past 2 months. We'll track the euro dollar through the morning. But there's almost like a cessation of violence across the assets as we go to the quarter end and the month end. It's as if there's a sense of exhaustion in equities and bond markets to a certain extent. The S&P has had its worst month of 2023, down 5%. So we pause for thought on the equities this morning. It's almost as if the Fed speak from Goolsbee, where he talks about, look, you risk a policy error if you keep looking at historical data and historical models. And to that extent, you could have a policy error. Consumer spending was a lot weaker, the weakest that we've seen in a year. The price index from the consumer component was also the lowest that we've seen since 2021, setting us up perhaps for a more bullish PC deflator today, which could help take some of the steam out of this hiking narrative. Don't forget, middle of the week, we were talking about 7% on rates. So futures are just bouncing a little bit this morning on the equity side. Europe up by 0.7%. When you roll it over and you look at the assets, you have, again, this sense of exhaustion coming to bear. Mini intervention from the Japanese. I think this is significant. This is a message not only to the bond market, as we saw the longer end of the Japanese curve make decade highs. The Japanese come in today and they say, no, enough. We're going to jump in here. They're using the flexibility of yield curve control. It was small, but I would say it's significant in its indications. So you've got 10-year government bond yields just below the 0.77% where they jumped in. The dollar index drops ever so slightly. Again, this goes back to the view, has your run been done? The wind came out of the market yesterday on the consumer numbers, and the 30-year yield, I popped it in there. I mean, this is up the biggest quarterly jump since 2009. We are now in the fear stage for the bond market because you've yet to see some kind of doom loop of massive selling of bonds to perhaps de-risk and take losses. So there are many unrealized losses out there. Bill Ackman is saying that he wouldn't be surprised if you saw the longer end of the curve get to 5%. So that's the state of play on risk. As I say, there is that sense of exhaustion across these markets. And with that in mind, we go to the end of the quarter. Danny Berger is in Berlin, and she's had the pleasure of getting together with Larry Fink. Danny, top takeaway. Good morning.
Good morning, Manus. It's so interesting to hear you talk about fear in this market, because my top takeaway from Larry Fink was that fear would be the thing that caused an American recession. He was very critical of global leadership in that regard, saying that he meets with politicians all the time, and he says they need to have more hope, to which I said, so Larry, for president then, and to which he remarked, Danny, I am too young to be president, which was absolutely the best line of the conversation. But I want to get more into it, some of the details of what he said about rates and about the economy. So here's some of my conversation with BlackRock chairman and CEO Larry Fink earlier at the Berlin Global Dialogue Forum.
Look, we all have opinions. I mean, I've been saying for over a year.
I want to know your opinion, Larry.
My opinion is we're going to have 10-year rates at least at 5% or higher because of this embedded inflation. This structural inflation is unlike anything. And I think business leaders and politicians are not providing the foundation to help explain this. We have not seen inflation like this in over 30 years. Actually, I was a young bond trader during the late 70s and where we had hyperinflation. I don't think we're going to have anything close to this inflation of the 70s, but we have so much deeper structural inflation, and we are underestimating the change in geopolitics is so structurally inflationary. When I was in Davos earlier this year, I heard the phrase national security uttered everywhere. And quite frankly, I never heard those phrases uttered that often before that in all my years. So national security for chips or food or energy, obviously energy, and all these issues. And the question is, at what cost? And nobody answers that question, at what cost?
Well, there are a lot of calls of a recession, hard landing, soft landing, no landing. They've all lost their meaning at this point. Let's be honest. So in this era of fear, of no hope, are we headed for
there's not no hope. It's all, I'm hopeful.
Let's hope. Larry's hopeful. We're happy about that. But does that mean we are headed for a recession right now?
So I think we have to analyze that by each region, because the United States, our home mortgage market is based on a 30-year mortgage. So anybody who has a home mortgage, higher interest rates does not impact them. And so the transmission of high elevated interest rates in the U.S. takes much longer to impact the economy. Whereas in other places where you have more floating rate, or like in the United Kingdom where you have generally a 5-year fixed and then it resets. And then, so let's assume 20% of the mortgages have to be, reevaluated at a higher level. That creates more immediacy at higher rates. So I think we're going to see some economies enter recessions early.
Which ones would that be?
Well, I think Europe
is anyone's more sensitive to
the ones that are more sensitive to this elevated interest rates, and you're starting to see a real decline in GDP and other. They're basically flat now, but can they go into a more protracted recession? Whatever the recessions we're going to have, they're going to be quite modest. So I'm not even that fearful. But the other issue.
I have a stat for
let me just say one thing,
yes,
Danny.
Yes, then I'll inject the fear.
But I believe if we have labor shortages, if getting back to this whole social issue of how are we going to be doing this, in many areas you may need a recession to bring down labor demand. And I think this is one of the things that's going to impact in the United States. You still have a very vibrant economy. The United States, as I said, the J curve of the Infrastructure Act, the CHIPS Act, the IRA, which has huge implications, that's going to be creating jobs. And so it may require a more protracted Federal Reserve, and it may mean by 2025, the United States economy may be entering a recession, but I don't see it any time in the near term.
So it might be a few years, but there still might be a recession. That was BlackRock Chairman and CEO Larry Fink. Manis, our interview on that, the write-up of it, it goes more into BlackRock's hunger for more deals. That's one of the most read stories on the terminal this hour, and we'll, of course, have more of his comments ahead, Manis.
Don't worry, I'm tracking you most read. You got plenty of headlines out of there. It's interesting that he talks about the structure of the UK market and their mortgage market versus the structure of the mortgage market here, and that is perhaps the saving grace here. You're all on 30-year mortgages here, and there's a lot of people never moving out. But good, you got the 5% call, above 5% on the 10 years. It's been a hell of a month for the bond market, moving by 50 basis points. Well done, Danny. It looked like an enjoyable conversation. We'll get more of it in just a moment. Let's just talk about some of the other stories that we're tracking this Friday morning. We got there. We didn't break anything. Well, at least not yet. The House Republicans, they released the text of a GOP leadership-backed stopgap bill. That would fund the government for a month while making cuts to some non-defense domestic spending programs. Prospects for legislation, well, that's uncertain. And far from suburban Detroit, a less splashy labor fight is unfolding. Unions in Arizona are negotiating with the world's biggest chip maker, TSMC, on the resolution of labor issues that have dogged TSMC's Phoenix construction site, a flagship project of President Biden's effort to make more critical electronic components right here in the US. And then there's the Bank of Japan, as I mentioned at the top of the show, the unscheduled bond buying operation. A reminder to the market, there's a determination to manage the upward momentum in sovereign yields. It's called flexibility, flexing the muscle of YCC. Let's see what Jane Foley makes of all of that. She is our guest a little bit later on. She is the head of FX over at Rabobank. Jane Foley on Bloomberg. And we've got a CEO, another one for you. Roy Jacobs joins the Bloomberg brief later this hour, right here on Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. they're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
This is Bloomberg Brief. I'm Menace Rennie in New York. Danny Berger reporting from Berlin today, where she sat down with Larry Fink. More of that in just a moment. So, today was the day when the Bank of Japan went back into the market. This is yield curve control flexibility. It wasn't huge. It wasn't a monster move by the Bank of Japan, but they did come in and they intervened. They bought 300 billion yen. $2 billion of 5- and 10-year paper. Let's see what the FX world makes of that message to the rates market. Jane Foley watched the action and has, I'm sure, an opinion. I take this as a warning sign, not just to the rates market. I take it as a warning sign to the FX market as well. How do you extrapolate the mini intervention this morning showing the flex of YCC? Ms. Foley, good morning.
Good morning to you, Manus. Well, you know, timing is everything, isn't it? And it's interesting that they chose today to exercise a little bit of the flexibility of yield curve control on the day when U.S. Treasury yields are relenting a little bit down off their highs. I mean, to be honest, if they had tried to repress JGB yields just a couple of days ago, well, I think the market would be even more worried about the prospects for dollar yen, you know, heading higher. So I think the timing was right today to do that. We've got to remember we also had some Japanese economic data out this morning, quite a lot of it. We had some CPI numbers, we had retail sales, we had industrial production too. And what the CPI showed us, particularly the core measure, is that inflation pressures are coming low. And we've got to remember that, you know, the official forecast for CPI inflation in Japan is for it to come way back below that 3% level next year, around about 2.5%.
Well, Jane, so they get a bit of a relief from the inflation story. They get a relief, I mean, even Europe inflation coming down too. But when you look at the relenting march in bond yields higher, at what point are they going to get a true test? That means that they can no longer have YCC, that it's unsustainable and just becomes too costly to defend the targets.
Well, we've got to look at dollar yen, you know, for that. And we know already that there is a lot of discomfort. 150, 155, certainly there will be a huge amount of discomfort, because we've got to remember it's not necessarily for Japan's biggest companies. You know, that the Toyotas, they're all very outwardly facing. They can export into this. They can perhaps benefit to some degree from the cheaper yen. But it's those companies that are the smaller companies that have to import in their raw materials and sell domestically. They're the ones that have really been suffering from this weaker yen, and the economy is not strong. So there is a point where the weakness of the yen makes things, you know, a lot worse for the domestic economy, for the growth outlook for certain sectors of the economy. And I think we're hitting the point where politically it's going to be quite difficult for the Bank of Japan to keep on defending its policies at this point.
Jane, we're going to spend more time on the shutdown. We've got the shutdown clock. We are counting down. It looks like there is no resolution or a lack of resolution at this juncture. Now, the FX world is divided. I've got Kit Jukes making it very clear that a shutdown would be injurious to the dollar. The prolonged US shutdown would bring the dollar closer to its peak, because basically, you know, risk aversion would be brief. In other words, the bid that you say we will get for the dollar will be brief. How do you respond to that?
You know, again, I think this is all related to timing. Now, I think one thing's very clear. If this was happening in any other country, we would see a big sell-off in the currency. I think we can all understand that. But the dollar dynamics are somewhat different. And this is really related to the fact that the dollar is the very, very dominant currency on the global payment system. And so what you tend to see is that when there is any degree of crisis, almost irrespective of the cause, even if the cause is the US itself, that you see people wanting more dollars in order to pay those invoices or to pay the dollar denominated debt. And so that's, you know, really where the safe haven bid comes from. And I think for at least if we have a very short shutdown, the market will appear to be looking through this because we don't tend to have these big reactions, negative reactions on the dollar to negative US fundamental news. So I think for now we can hold steady. But I do.
What derails the dollar's rally, Jane? What do you see credibly that could turn this around? I mean, it's lower this morning, but what then, if anything, could derail the rally?
Well, generally, when we have people moving away from the dollar for a prolonged period, it's generally because they see opportunity in other currencies. So generally, it's when we have high risk, a risk-on environment. But the problem is right now is that, yeah, you know, you might have, you know, a slowdown in the US. We certainly think there could be a mild recession in the US, evident early next year. And yet, what are you going to sell? Because are you going to buy, you know, China? Are you going to buy euro? And this is the problem. So even if you have a slowdown in the US, it's quite likely, I think, that the dollar will remain pretty well supported until you have risk appetite building. And probably to trigger that, you will need a real feel that the Fed interest rate cut is around the corner. And of course, the market has been pushing those expectations back recently.
Well, let's see what the PCE deflator is today. A lot of people are sort of saying, if you look at the consumer data yesterday, it perhaps sets us up for that slightly better narrative. Let's turn back to our top breaking news story at the top of the hour, which was core inflation in the Eurozone hits a one-year low. Does that reinforce a pause? I mean, I looked at the euro before I came on here, down 2% in this month. It has had that bruising stagflation hangover, and here we are. Core inflation hits a one-year low. What does that do to the euro? It's hardly flinched at the moment. So I just wonder, is that rollover in inflation all in the price? Jane?
Well, you know, I do think that we're going through a little bit of a pause. We're back above 106. We've seen equities a little bit higher. So we're having a little bit of a breather right now, and that could extend maybe for another couple of days, maybe not, because I do think the fundamentals for the Eurozone are not quite in the price yet. You know, we had a recession already for Germany last winter. We've got stagnation now. We've probably got, in our view, a stagnation for the whole of the Eurozone in the second half of this year. So we've got some real strong growth headwinds, you know, facing the Eurozone. And I think that is a situation which could really drag on the euro for a prolonged period.
Okay, Jane, thank you very much. Giving us her view on the FX markets live and real. Jay Foley over at Rabobank. I want to give you a quick snapshot of what's going on in the bond markets, because you are just seeing these yields roll down across the market. In Germany, core inflation is at not Germany, in the Eurozone at a one-year low. But you saw such a monster move yesterday. The yields on 10-year paper rose by 20 basis points to 4.56%. So you are just seeing, as Jane says, there's momentary pause in some of the, I suppose, vertiginous moves that you've seen in these bond yields. Check them out. They are relevant as we go to the quarter end and the month end. It's been vicious and brutal, and the vigilantes have not only had breakfast, dinner, and supper. Good morning from New York. This is Bloomberg.
the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger reporting from Berlin today. Manus Cranny, as always, is in New York. Manus, let's talk banks. Because Credit Suisse says it may incur losses of $2.2 billion in the third quarter as it exits more businesses following its acquisition by UBS, Manus.
Yep, that ongoing transformation and marriage of great inconvenience rolls on. Elsewhere, we've got the Saudi Arabia pending a deal with the PGA Tour, maybe scuppered by Henry Kravis, Endeavor Group, and Fenway Sports Group. The American investors are exploring potential investments in the golf franchise. For more on the story, let's get to Joe Easton. He's in London. Joe, does this threaten the PIF's attempted merger? Would they supplant the PIF? What's the top line?
I think it could threaten the deal, given that there was a lot of backlash against the Saudi merger, even among players, largely due to the political aspect, with a lot of even politicians in the US speaking out over it. And the backlash wasn't like we saw in the UK, with the Saudis investing in football here. People kind of accepted that. In the US, it didn't. So I think it is a threat to that deal.
Joe, just because we're all among friends here and the many viewers of Bloomberg TV, I got to be honest, I don't watch golf. So you need to explain this to me. Only a minute here, Joe, but why all this attraction to golf right now?
She's just committed a crime.
You're going to be glued to the Ryder Cup, Danny, all weekend, which is just kicking off at the moment over in Rome. We'll all be watching that. But it is very popular. It's grown a lot. Even during the pandemic, there wasn't much else to do, so people went out and played a lot of golf. It's the kind of thing that once you play it, you realise how difficult it is, and then it's more exciting to watch on TV. I mean, the statistics from the industry say around a third of Americans have at some point played or had some interest in golf. Even in terms of, there's venues like Top Golf where you can go and have a drink, so it's popular.
Well, I can tell you for nothing, I've tried it. I gave it up. I lost so many balls. I just gave it up. I never really made it past a handicap of about 15. Joe, thank you very much. We'll talk more about golf and maybe even policy with Terry Haynes, the founder of Pangea Policy, right here on Bloomberg. Countdown to shutdown.
middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York. Danny Berger on location in Berlin, where she's been speaking to the BlackRock CEO, Larry Fink. Here's what you need to know. The clock ticks closer to a deadline. The U.S. shutdown appears all but inevitable. Kevin McCarthy continues to struggle to get the hardline Republicans on board. The demand comes clear from the UAW. Auto workers want at least 30% pay rise from Ford, GM and Stellantis. The prospect of a resolution may help investor sentiment, and the BOJ announces an unscheduled bond buying operation after yields across the curve climbed to decades highs. Okay, so with all of that in mind, the equity market has had a pause for thought. It's as if the aggressive sell-off that you've seen across equities, the S&P heading for its biggest loss of 2023 this month, its month end, its quarter end, are they really sufficient reasons to justify a bounce of 0.5%? It's not a mega bounce, but certainly Fed peak is back in the conversation against that narrative earlier in the week that rates could get to 7%. Consumer spending was the weakest in a year. The price index was also the weakest since 2021. So that builds the narrative. Maybe there's a construct for the Fed to pause. You've got Nike at the bottom of your screen up 8%. That's what's called destocking, and they are comfortable with it. Taking inventory off the shelves, getting ready for new stocks with higher margin. Pump up your shoes, pump up the air, 8.2%. NASDAQ's up at 0.6%, as there's quite a dramatic roll down in yields. Europe is up by 0.9%. Roll it over and you'll have a look at what I mean. The yields, and Larry Fink spoke to Danny about this in terms of what's happening in the middle part of the curve at the 10 years. But look at this. We've had this drop in the 30-year bonds. 10-year bonds are rolling over. Globally, look at all your bonds, UK, Germany, and the United States of America. All the yields are coming off those sort of existential highs. 30 years are in the fear stage, which is the biggest quarterly loss since June 2009. Will asset managers now be forced to sell and realize those losses? That's the next shoe to drop. The dollar is down as yields roll down, and we are in this fear stage. We will get a shutdown. Would you buy the dollar in a shutdown? Is that really where you want to be? Or is that the end of the peak dollar story? And there's intervention from the Bank of Japan. They did it today, Jen Foley says, because to do it just a couple of days ago would have been so folly and basically non-impact. The BOJ flexing its YCC credentials. Danny, good morning. You got a call from Larry Fink. He reckons rates are going to 5%, and he differentiates what we should talk about when we define recession. Good morning, Berlin.
Good morning from Berlin. Menace, it's fascinating to to hear him talk about the structures in place that are going to cause a recession, that are causing this embedded inflation. Because we talk about it all the time, but he was of the opinion, look, with global supply chains, they are changing, and that's going to keep inflation high. He also talked about AI. You know, Manus, I asked him if he thought I could keep my job, and he said that both CEO and my job would go. That doesn't bring me any comfort. What's up with that?
To see the hologram of me, you know, that's not very hopeful, is it?
Hey, as long as we can be on a beach somewhere while it's happening, then I'm okay with it. But I want to bring you more of my interview with the BlackRock chairman and CEO, Larry Fink, because he also had a lot of comments on the American economy. Take a listen.
In many areas, you may need a recession to bring down labor demand. And I think this is one of the things that's going to impact in the United States. You still have a very vibrant economy. The United States, as I said, the J-curve of the Infrastructure Act, the CHIPS Act, the IRA, which has huge implications, that's going to be creating jobs. And so it may require a more protracted Federal Reserve, and it may mean by 2025, the United States economy may be entering a recession, but I don't see it any time in the near term.
And part of that conversation, Manus, that Larry went on to talk about was the labor strife and the strikes, that higher wages were also feeding into this structurally different story. Now, on that point, the United Auto Workers Union said it wants a 30% raise from its strike action at Detroit's 3 major automakers. Manus, let's bring in the latest. Joining us now is Bloomberg's Oliver Crook. Oliver, first, I mean, are you intimidated? Everyone's coming for your Berlin job.
No, this is the place to be, apparently.
He should be frightened.
Yesterday it was Wei Li. Oh, goodness. Okay, wait, where are we on the strikes? Where are we on the negotiations?
Yeah, so listen, we've had some great reporting out of Detroit from our team there, where we have about 30% is the figure that we've got now for the increase that they want. That came down from 46%, 40%, 36%. We're now at 30%. We understand that the UAW submitted a counter proposal to Stellantis yesterday. We have not heard back, but of course, this is a deadline Friday, 10 a.m. Detroit time. We'll hear from Sean Fain. He showed up last time in camouflage, and he expanded the strike, 38 facilities. The question is, will it expand again? Will it hit 4 this time? And it's also part of a broader effort, this also out of our team in Detroit, that basically they're trying to attract non-union labor. And the question is, in the United States economy, can you have a 2-tiered manufacturing system where on the one hand you have the big 3 union labor and Tesla on the other with a much lower cost base? This is going to be front and center for the economy and the industry.
Ollie, I know that you're looking at the much bigger picture about electric vehicles, which is part of this strike narrative, but Sean Fain wants to rebuild his base. What was it, 1 million subscribers a decade ago? So for the UAW, there's a much bigger battle going on here, isn't it? It's not just about whether they support Trump or Biden, it's about expanding the base.
Exactly right. At a point when this industry is completely, the ground is moving beneath it, and we don't know where it's going to settle, and really we're in kind of the foothills of this. And as we were mentioning, you know, Tesla has something like $45 an hour as a cost base for its labor. Can you really compete with that when they're way ahead on EVs? Ford is losing $4.5 billion this year on EVs. This is really a transformational moment. So what Sean Fain wants to attract is, yes, he wants to get a living wage for these workers that are currently representing, but he wants to represent more workers, the workers that work for Tesla, the workers that work for some of the Asian automakers, and even the European automakers, which would completely rewrite the narrative of how labor works in the United States in the manufacturing sector.
Well, here's the thing. I got a WhatsApp last night. Let's bring Danny into the conversation. I got a WhatsApp last night from Martin Malone at Alpha, and he said, Gavin Newsom just put minimum wage up to $20. Japan has a wage differential that's going to blow the mind off everybody. In other words, you're going to reshore from China into Japan, friendshoring to Japan. And it's based on these much higher base salaries and minimum wages, which is good for workers and should be, treat people properly. But it is about that wage differential around the world, which drove everything to China. And now the base thesis is wages costs are now so competitive, it will be a flow show to Japan.
Yeah. I mean, are we really still going to get back to a world of 2% inflation, Manus, if this is the labor story, if we're onshoring, if we're reshoring?
We are. Listen, Danny, I presume you're on first name terms with Larry. I just want to ask Oliver. Oliver, did you get Larry Fink's telephone number? Come on. Did you say hello? Did you meet and greet?
No, No, I did not. I focused my energy last night on the subject of AI, and we did a panel on that. But again, it's actually it's touching some of the similar themes. Can where labor is moving, the AI story. A lot of these people who are training the AIs are in lower cost labor markets.
Okay, Ollie, in Berlin, alongside Danny, keeping it real there. Well, the deadline is looming for this U.S. government shutdown. That is top of our agenda. Terry Haynes is the founder of Pangea Policy. Let's get his first take on this. Terry, good to see you this morning. You say we are underpricing how long this shutdown could run for. What mistake are we making in our hypothesis as we go to this countdown clock?
The mistake, Manus, is simply that when markets hear, when investors hear shutdown, what they think is, based on past experience the last 20 or 25 years, that it's going to be one and done. We don't know how long it's going to last, but it's days to a week, whatever. This is very different. This is a situation where Congress hasn't done any of its work on its spending bills, a bipartisan failure in my estimation. Any group that takes a 7-week vacation instead of buckling down on spending bills is to blame, so they're all to blame. But what's really happening here is that they need to start working on those, but it's going to take until Christmas to finish them. The trigger here really is defense spending and defense authorization, the how those things are spent. That will take until Christmas. What that means is they've essentially got 3 more months on every other spending bill before they have to wrap it up. And the forcing event is that in January, according to the May budget deal, the forcing event is that if they don't have some final deal, they have to be mandatory 1% cuts in spending. So they won't want that.
Terry, let me throw another spanner in the works for you. Yeah. While you're talking about that, a story out from the Washington Post this morning saying that far-right House Republicans are plotting an attempt to remove Kevin McCarthy as House Speaker as early as next week. From what you see in D.C., 1, does that seem possible? And 2, what is that going to do to a shutdown?
Sure, it's possible. But I will say about the kind of the 20 purists that are constantly plotting against McCarthy is that that's a leverage point. They try to use that for leverage. Once they trigger that, and let's say they remove McCarthy, what then? Who's going to be Speaker? So you have a possibility of some real chaos in the House if there's no Speaker and nobody to lead the entire body, which is McCarthy's job. And that actually plays into my theory, because if you'll have a shutdown for some time, and the House will be actually unable to do a lot of its business. So that feeds into the fears of a lot of folks, I think, who are joining a flight from treasuries and are concerned about the upward trajectory of debts, deficits, and spending in the United States.
So, Terry, let's just move along. I mean, chaos is something that the bond market potentially took notice of in the sovereign rating for the United States of America. The other fact is, of course, this ongoing UAW strike. It looks like 40%. The new figure that they want is 30%. What I want to know from you is, we saw a lot of theater this week. I watched a lot of networks. Joe Biden on the picket line with the UAW. Then you had Trump speaking to the workers in that industry. What is the takeaway this week? What is Biden more frightened of? Not being seen as the workers' president, or of Trump stealing his votes in that zone?
The answer is yes, I think. I was concerned about both. Look, when you're fighting to retain parts of your political base, and unions writ large have been bedrock part of the Democratic base for almost 100 years now. When you're fighting to retain your base, you're operating from a position of political weakness. So that's what really Biden's trying to do, and Trump is trying to capitalize on the restiveness of the rank and file, many of whom voted for him, to try to peel that away. So, and in a swing state like Michigan to boot. So there's an awful lot of back and forth on the base here. But the other takeaway I would make for you is that it makes it harder for Biden to actually try to capture the center. And there's 20 to 40% of independents that may or may not vote for Biden. Makes it more difficult for him.
Terry, great to get your input this morning. Let's see what the countdown clock shows us at the close of business today, but it doesn't look that healthy. Terry Haynes, Pangea Policy Unit there with his thoughts. Coming up, we'll have a conversation now with the next CEO on Bloomberg Brief. Roy Jacobs joins the conversation on Bloomberg at 5:42 in New York.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
When you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder.
This is Bloomberg Brief. I'm Menace Craney in New York with Danny Berger reporting from Berlin today. Joining the show is Roy Jacobs, CEO at Philips. Good to see you, Roy, this morning. We've just finished a conversation with one global leader. Let's bring it to you. No recession in the US until 2025, but prepare for more shocks. How do you see the road ahead? Is there any slowdown in your business? Good morning.
Good morning. Good to see you. Looking at the world, when I started the year, I said this is for sure not a year that is going to be business as usual, and that is actually taking effect. We do see that there are different trends in the world. The US, we do see strengthening a bit. So I think in that building on what was just said, we see some of that also back in our business segments, both in the healthcare segment as well in the consumer segment. But globally, we still see also challenges in Europe, which is slower, China, which actually is still slower. So overall, the world macroeconomically still is not in its best shape, but we do see it slightly improving in certain areas.
We're grappling with strikes from the UAW. You have many manufacturing plants in the United States of America. You're a new CEO. Set the tone for wages at Philips. Are you a supporter, an active supporter of wage revision and revising them higher? How are you going to set the tone for wages from the top at Philips?
So we are in active dialogue continuously also with our workers and also with our manufacturing facilities. So far, actually, everything is conducted in good faith, and we are running at full steam. We have also been raising wages across the globe in line with market conditions and inflation. So it's something that we have been supportive in because labor is short. It's important that we keep the operation going. So we have been taking action there.
Do you still have labor shortages?
We do see certain areas where labor is short. For example, we are dialing up big time in AI and in the area of software. Of course, that is something that many more are doing. So that's an area where we are hiring and taking people from the market. We also are able to recruit, but it is a short market. So there are specific people that we are after that are in high demand, and that's where AI plays part.
So tell me, you're spending on AI briefly. What would you say your budget on AI is? Are you spending $1 billion, $2 billion in hiring an AI? What's the round figure for AI? We'll get to the recall in just a second.
Yeah, if you look to kind of our R&D spend, it's around 1.7 billion a year. Of that, more than half is actually software, and AI is an increasing part of what we do in software. So actually, AI is really taking a significant shape of that, and the application of AI is also really impactful. We're already using AI today, for example, to help to predict an event from happening when a patient is in the hospital, or to increase scanning times by 3 times by putting AI on an imaging device. Also, we are using it and looking at generative AI, how we can use it to reduce the administration time that a nurse uses per hour, average 15 minutes, to make their work easier.
Let's get to the big issue. Your stock is down by 50%. You've come in to turn this company around on the CPAP recall. I've got figures in front of me saying 5 billion euros is the right number for litigation. You've only provisioned $1 billion so far. What is your estimate, your best estimate now to the market on what this recall and litigation is going to cost you?
So the recall, of course, is very important for us, first and foremost, from a patient's perspective. We made great progress in remediating the patient's sleep. Remediation by now is nearly done. We are at 99%, so the patients are getting, the devices are getting back on therapy. That's also where we provided the 1 billion for, so that actually has been moving along with pace. The second part is we have been closing on an economic loss provision, where we provided 575 million earlier this year, Q1, and we just settled it at 479 million. So we also have been closing that out. Then there is further litigation coming.
So can we have said earlier that most likely. That's the question, Roy. How close to multiple billions is it going to be? Briefly.
We don't speculate on that number. It's too early. We're in the process of going through the investigation on that. So we have not put a number out. If we have, of course, insights around that, which we said probably is not earlier than 2024, we will bring that to the market.
What's the progress on the recall? Just remind us where you are in terms of the recall. How many have you brought back in? How many more to go?
So in essence, the sleep recall is nearly finished. We have replaced 99% of the devices in the market, which means, and that's great news for the patient, that they are back on therapy. Mm-hmm. So actually that part is really being dealt with, which also allows me to focus on the other important part of getting Philips back winning again and progressing on our performance journey, where we have seen that we have now 3 quarters of growth, and that is on very distinct actions on improving our execution, both in patient safety and quality, in supply chain, but also in simplifying the organization. So we are on a track where we're improving both growth and profitability on a quarterly tenure.
As I look at this storyboard, and I've interviewed your predecessor for 10 years, I'm introducing myself to you. I want to know who you are as a CEO. You've got a DOJ investigation, open-ended financial risk, and a reputation crisis. As those issues mount, would you support clawbacks on your predecessors if it is found that they deliberately, perhaps, withheld information? Are you a supporter of clawbacks and penalties to predecessors?
I'm focusing actually on bringing Philips back to where it belongs. And that's where I presented the plan earlier this year. That's where actually I've been relentlessly focused on improving our execution, getting momentum back. We're seeing that also coming back. We are able to provide more innovation solutions to the healthcare customers that we serve and also the consumers that we serve. The 3 progressive quarters of growth are underpinning that.
But do you think that implementing something like clawbacks would help restore the credibility and perhaps give you the opportunity to say, this is who I am. I'm going to make sure that there's some kind of accountability here. Just briefly on that, and we will move on.
So I've been taking accountability for the future of Philips at the moment I started, and that's what I focus my time on. That is resolving the recall for patients, is also working through the challenges that are tied to the litigation, but also very much focused on getting the other 18 billion of Philips to get really to true value potential. And you saw, for example, a big investor coming in, putting 3 billion into Philips because they are excited by that value creation potential that Philips has. And that's something that they see underpinned by the actions that we're executing on.
Will they take a bigger stake, and how active have your discussions been with Mr. Elkin?
So we have been actively engaged because this is not only about money, it's about building trust in each other, building trust in the trajectory. They have been taking a 15% stake. They can take up to 20%. They're putting a clear vote of confidence in, and that actually is a great subscription to what we are working towards. They also have great experience and a track record in other industries that they're in of value creation. So together we are on this path to really bring Philips back where it belongs.
We just heard from Larry Fink. He says he's underinvested in China. We hear lots of politicians telling us from the United States to Europe, which is de-risk from China. When you hear de-risk from China, what does that mean for you as a CEO? Are you preparing to decouple, retrench, friendshore from China in terms of your manufacturing?
So China is an important market for Philips. Around 15% of our revenues are in China. But what's important for us is actually that we adapt to the new situation in the world from a global supply chain perspective. And the global supply chain in the new world requires that you regionalize more. That's not only China, that is also for Europe, that is for the Americas, that is for India. So we are actually making sure that we have the right setup to serve our customers in the specific regions.
So briefly then, will you retrench from China, Roy? We're up against the clock, and I need to know, will you retrench?
We will not retrench from China. China remains an important part of the future of Philips and also how we provide services in China, but also to the rest of the world.
Roy, it's been great to catch up with you. It's always tough when you've got a big job to do, which is to restore value. We wish you well, and hopefully you and I will be talking in 10 years' time, as I did with your predecessor. Thank you for your time this morning, sir. That is the Philips CEO, Roy Jacobs, there. Let's get to Danny. She is in Berlin. Well, there you go. He's not retrenching from China, and Larry wants to do more. You're on first name terms now with Larry, are you?
Well, I think it would have been weird if I called him Mr. Fink during the conversation. I don't know. It seems a little bit too formal. Manus, that was such a fascinating conversation on many levels. But the difference of opinion one could have on China, it does come down to how you are positioned. Philips perhaps is not in a position where they can retrench from China. BlackRock, the world's largest asset manager, perhaps is in a position where they can stay and they can wait it out. I also talked with Schwartzman last week. Same thing for Blackstone. They're also in a wait and see, and for the moment, kind of retrench on China. I
think it's interesting the way Larry differentiated, you know, this is going to be an extend and pretend situation. Well, not so much pretend, but extend. We're not going to have a recession until 2025, in his view. And it's a much stronger, it's a more muscular US economy with higher wages, and people have jobs. And therefore, that plays to Goldsby's thesis yesterday, which was don't look at the historic models on how you break an economy, deflate an economy. You've got to have this massive unemployment. Goldsby warns, don't bank on the former models as the way forward.
Yeah, that's exactly what Larry Fink was talking about, the transformation of the economy. Manus, I have to go back to this line because I love it. I think you'll enjoy this too. He was talking basically about how politicians were too pessimistic, but he was hopeful. So I said, all right, so you going to run for president? Manus, his response, the response of 70-year-old Larry Fink was, I'm too young.
That is a wonder. That is music to my ears. Absolute music to my ears. Himself and Jamie Dimon. So what do we see? Jamie could be president, and Larry could be what? Treasury secretary. There you go. He's too young to be the president. Yeah. There's a powerful combination.
You can be chief of staff.
I can be chief of staff. We just
That's a great cabinet you put together.
We just need to find Jane Fraser. She can step in. We can have her at the head of the Treasury. Larry can run another part of the business, and Jamie can be president. There we go. We've solved the US issues in a beat. Danny, good morning from New York.
And good morning from Berlin.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Yields are being pinned because the Fed is talking tough at this point, and the market realizes that.
We were bracing for a higher for longer environment with a higher cost of capital.
It's the end of free money, and we think it's a good thing.
I just wonder whether there's a turning point happening now which isn't visible yet.
When you see this kind of volatility, especially in yields, it's the concentration of risks that will cause something to break.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get you to the weekend. Let's get you to October. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P with a lift, trying to end a brutal month on a high. Your equity market on the S&P up by 0.5%. TK, I think we can call this a month to forget.
It's a month to forget. It's a quarter to forget as well. A lot of moving parts here. And, of course, this morning we see just the same tensions that we've seen all through the week. I'm going to go back to something said months and months ago. I did a wonderful panel with him for Bloomberg, Nassim Taleb, the acclaimed Black Swan quantitative finance expert. And he said, the gravity has returned to the market. It was a grave September.
That gravitational pull, Tom, over the last month or so gets a little bit stronger in the bond market. What a range we've seen, Bramo, in the last 24 hours. The high of the session yesterday, 468.61. Just south of 470 on a 10-year. This morning, we're at 454. And I'm not sure what that turnaround is based on, Bramo. How much new information did we get in the last day or so?
Maybe we got softer than expected inflation data out of Europe. Maybe you got $2 billion of bond buying out of the Bank of Japan that did very little for the actual market. I'm just curious how much we're looking at volatility in treasuries, unlike anything we're seeing in credit or stocks at this point. This is where suddenly bond markets are really what's showing the volatility that normally is associated with very different asset classes.
I don't know who we have in the 8D block, the last voice that we'll hear here across our 3 hours, but I'm certain in the first block on Monday, we had young Luke Kawa of UBS, and he said it right to your idea of volatility. We're now into the first and second derivatives across all the asset classes, and that's why you see David Weston with Ray Dalio today, a bit of tension. You see Danny Berger with Lawrence Fink, a bit of tension.
Yeah.
There's a whole lot of tension around the great and worthy right now.
For whatever it's worth, 8:45 Eastern Time, Oliver Chen of Cowen.
Is it Oliver Chen?
You can talk retail.
So we'll be talking
luxury.
retail
We'll
fashion. What to buy at Celine that won't shrink.
Okay, we're going to do that again. That sounds like fun. Let's talk about some news, the potential for some real news. 2 deadlines. UAW a little bit later this morning. Government shutdown looming going into the weekend. Bramo, what you focused on, UAW or Washington, D.C.?
I'm actually more focused on UAW because Washington, D.C. seems like almost a certainty that there's going to be a shutdown. There's a real question around how Biden will shut the government down because he does have some discretion on that front. But really it comes to how entrenched are wage pressures? How much can companies keep passing along to workers versus taking for themselves in terms of profitability? This is something that's broadening. We're seeing this pressure build. And to me, I mean, Larry Fink, Tom mentioned this, he also said that corporate executives and officials have not done a good job explaining just how entrenched inflation really is becoming in the economy.
Based on our reporting, the ask comes down from 40 to 36 and down to 30. We'll build on that a little bit later. Your equity market looks like this on the S&P 500. There is a lift. We're positive by 0.4%. We're still down just about on the week coming into Friday, down on the month on the S&P 500, not just in the equity market, in treasuries too. Bonds down, stocks down, that hurts. Yields lower this morning by 3 basis points, 4.54, Lisa, in the bond market.
It has been an exceptional month. What I am watching today might be the last slew of data that we actually get before the government shutdown delays a whole bunch of data. 8:30 a.m. we get U.S. personal income and spending. I'm more curious to talk about that and how much consumer discretionary funds are still available rather than Celine and shrinking sweatshirts. I also am curious about core PCE, which will come out, the favored measure by the Fed for inflation. Yes, it's expected to come in, but upward revisions expected from previous months, so watch that. 10 a.m. University of Michigan Sentiment Survey. I know a lot of questions around the validity of something that surveys 3 people, but at the same time, not that many. There are many more than that, I understand that, but I'm looking right now at the expectations 5 to 10 years forward of inflation, because if you look at markets, it has gotten sticky at 2 point something, 2.4, 2.5. This is not the Fed's 2% target over the next 5 to 10 years. And at 10 a.m., there is that UAW announcement ahead of the 12 noon deadline for strike expansion. A real question about whether they are going to go after still Stellantis and GM, whether they're going to broaden to Ford, whether they mark progress with 30% wage increases. And that's the line in the sand, as you just mentioned, John.
A Facebook Live event about 4 hours away with the UAW president. For whatever it's worth, that Celine sweatshirt now has bleach stains on it as well. So it's
so
both
it's really
shrunk and
getting
it's like, you know, that pink dye? Forget about that.
Oh, man.
Julian
Okay.
with us around the table. Julian Emmanuel, Chief Equity and Quantitative Strategist over at Evercore. Julian, fantastic to catch up with you, sir. Good morning.
Always great to be here.
Let's talk about that pullback in this equity market. Is it time to buy?
It is. So you hit on 2 very important themes just now. The first, the concept of a bit of tension, okay? The wall of worry that was almost non-existent in July as AI was leading us to the new world and then suddenly started getting rebuilt at the top is now fully rebuilt. And how do we know that? Because basically, if you look at the market yesterday, there was a very, very noticeable change when the UAW came out and lowered their offer, making the bid-offer spread 21 to 30, as opposed to that original 40. And that's when bond yields turn lower, and that's when stocks turn higher. And we think there's a lot more to go of that type of action in the fourth quarter.
So this equity call you're making is essentially a bond market call, correct?
How can it be otherwise when you look at the action in the last year and a half? The two are positively correlated. It's a new world.
I want to talk, and I'm fired up this morning because I got great and worthies running around the world spouting economics, and it just drives me absolutely nuts. Let's get back to common sense. You work for the most famous market economist in the world. Edward S. Hyman invented the game. I want to get from Ed Hyman to Julian Emmanuel. What is that linkage across the Hyman predicted disinflation?
So Ed's call, again, disinflation, it has been very consistent. And what's interesting about the current environment is it's very rare that you see oil prices ratcheting higher the way they have, whereas copper prices have been going lower. That tells you that what's going on is more geopolitical than an entrenched inflation psychology. That's going to continue to unwind, right. Likely a slowdown, but the commonality here is when you look long term, the reason the market is likely on better footing in the fourth quarter is because earnings are going to continue to grow next year.
Tell me about the character of nominal GDP, the animal spirit. Hyman, he's looking at freight cars, he's looking at pickup trucks. He knows what Taylor Swift's going to drink at the football game this weekend. Ed's omniscient, okay? Take his research and bring it over to nominal GDP and to the top-line revenue growth that generates that earnings enthusiasm.
Well, the first thing you got to say is it's interesting because now there's a reason to watch the Jets game live for maybe the first time in years because Taylor Swift may or may not be there. Look, the fact is that, again, part of why this environment has been so difficult is because the economy is so incredibly diverse. And actually, when you look at Ed and Oscar's surveys, what we've seen was the trucking survey telling us that we should have been in a recession for the last 9 months. But because the manufacturing side is so much smaller than the services side, and the airline survey has been on fire, literally for years. We all know how difficult going through airports are, and we all know how much air prices have gone up, is that the economy, again, this diversity is likely going to get us through so that even if we get a downturn, it's mild.
I never took you for a Swiftie. I just am throwing that out there. It wasn't really on my radar. What are you buying then? Because if there is this bifurcation in the markets between different industries that are going through recessions at different times, what's going to lead the drive back to 44.50 by year end?
So we think you need to be really thematic and really focused here. The energy story is absolutely going to continue to play out. Again, this is geopolitics more than anything, but geopolitics is going to keep the oil price elevated, we think, certainly until next November. So again, the only sector that basically is pricing in a recession. Healthcare, which is actually immune to geopolitics and interest rate gyrations, very good secular story. And what we like, again, the generative AI, it's not just the arms merchants, you know, the stocks that we thought that armed the internet in the 90s. It's not just those, but it's the companies that have been front foot forward in terms of implementing generative AI, and we're going to be paying very close attention to earnings conference calls in the month of October to see who's doing what and to see what kind of ideas they have in terms of implementation. Those stocks will outperform long term.
Right now, as you take a look at the idea of more volatility heading into a really potentially fraught election cycle, how much does that actually make you favor bonds? Because typically you have to adjust for a higher risk premium in the more volatile instruments. Are bonds less volatile than stocks in this kind of environment?
Well, they certainly haven't been for most of the last year and a half. But again, look, we know the Fed is likely about to pause. Maybe there's one more hike left, and that QT will continue to run in the background. So we don't really have to worry about what the messaging is there. But it comes back to this whole idea that when you look at the energy complex, it is sort of off by itself. And so therefore, the case for bonds becomes a little bit more interesting to us.
Two of the most powerful quotes in the past week came out of Bank of America, the CEO, the CFO. It needs to be talked about way more. Brian Moynihan, we won't have a recession. The CFO, it's difficult to see a recession when the consumer is spending 4% more year over year. Can you identify any evidence of a slowdown that's going to lead to a recession anytime soon?
Well, you actually did see the consumption number ease a little bit yesterday. But frankly, when we look at, again, the weekly jobless claims number is the thing that we're focused on, and it is very strong. But here's the thing. We know there are some of these things building in the background that have traditionally, 70 years, been pretty good indicators of recession. LEIs, loan officers survey, the yield curve, et cetera. It doesn't mean that the recession is eliminated. In our view, this is a case of the economic cycle because of all the money we threw out being elongated.
The value to growth ratio is a record low, essentially a record low. Value's never underperformed growth like it has recently. Do you just stay with growth, or do you buy the value trap?
No, I think you have to, again, be very, very targeted. Because if you think about it...
Well, targeted what? Free cash? Help me out here. Free cash flow?
Well, it's a different story. Right now, there's a valuation edge in areas like energy, which are throwing off ridiculous amounts, I mean, insane amounts of free cash flow. And healthcare, which, you know, despite regulation, continues to be a one-way ticket because of the demographic tailwinds. And again, anything that is associated with generative AI is likely to be a company that's also throwing off good free cash flow.
Are you going to the Jets game this weekend?
No, my Minnesota Vikings have made a misery of professional football.
Have we confirmed whether Taylor Swift is attending said game, TK?
I collected Scarlet Fu last night, celebrity lodestar for Bloomberg surveillance, and Fu was working the phones all day with Taylor's people.
Okay.
And we don't know. It's Jets. For those of you not up to speed on this, like I'm the only one on the planet that's not up to speed on this, Scarlet briefed me, the Jets, Chiefs, not really a football game. I think it'll be 70-20 or something like that. And will Miss Swift show up in support of one of the Chiefies? And, you know, then it goes from...
Travis Kelce.
Yeah, what's the relationship there? And, you know, does she wear Eagles
It's the important stuff. You want to talk the money side of it. His jersey sales have exploded.
Yes,
As I understand, the price to get into MetLife is up something like 20%
really? Is it?
this
I didn't know
weekend,
that.
Even without confirmation.
Now, email
I'm
it
just
right
saying
now.
that even if they're not together,
Yeah.
just constructing some kind of relationship for PR purposes may well sound more jerseys, fill out stadiums,
Are you skeptical of
and
the
sell
actual love
tickets.
between these two?
I'm not saying. I'm not saying that. I'm just saying that if it were constructed for
PR sake,
for external consumption, that there are financial
Travis's
benefits.
mom looked pretty happy on Sunday, didn't
Did
she?
you see there are all these memes on Twitter, on X, about like the PR person for Kelsey just like sitting back and being
No,
like,
but
let's
seriously,
go.
folks, I know you don't talk to me. You talk to John and Lisa because you love them and you hate me. Send in your notes to John and Lisa. Should we set up a countdown clock for a Taylor appearance at our 3 a.m. At our 3 a.m. conference call?
If this doesn't work out, can you imagine the amount of hate mail he's going to get?
Well, it depends how it doesn't work out.
It's got to work out, otherwise it's just lose-lose for
So you
this
end up
guy.
getting married? Is that what you're saying?
Just saying, it's got to work out.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
I know Sunday is football day. It is the weekend. Sometimes we get right there, we play through. We get into overtime, we get it done. I've got conversations as early as this morning with Democratic senators. They want something on the border, they're working on it. And so I think there's an opportunity here. We know we have to keep the government funded.
The clock is ticking. House Speaker Kevin McCarthy there going into the weekend with the deadline just around the corner. Live from New York City, closing out the week, closing out the month. Closing out the quarter, your equity market looks like this on the S&P 500, attempted to bounce going into the close of the month. Equities up by 0.5% on the S&P 500. Yields come in just a couple of basis points. We're down 3, call it 4 basis points lower on a 10-year. 453.83 after coming really close to 470 in yesterday's session. The Euro's done it all this week. It's had a look at 104. It's having a look at 106. The Euro 106.14. Stronger Euro, weaker dollar at 106.14. We're positive here by 0.45%. Tons to talk about in Japan. The BOJ coming into the bond market and sucking up some JGBs. Bramo, there's been a feeling that maybe they're letting things go in the bond market to try and put a lid on this move in dollar yen. Alan Ruskin of Deutsche Bank was talking about that. So based on the intervention we've seen in the week, are they more concerned about what's happening in the bond market than they are about maybe what's happening in foreign exchange?
And how concerned are they exactly? I mean, how committed are they to some kind of move? Because either the intervention that they did in the currency market, not that big, wasn't that durable. The intervention that they did in the bond market was $2 billion worth that did basically nothing in curtailing some of the biggest move upward and the highest rates that we've seen on 20-year and 30-year JGBs going back to 2014. So not clear what this commitment is. Is it the beginning of something more durable, or is this the beginning of something that's basically like, you know, just slow down, guys?
It's like a warning shot.
Yeah, exactly.
But it's like a water pistol. Yeah. You know, there's like not much going on. That's all. That's kind of like the opening shots coming from the
first
BOJ.
of all, our reporting out of Tokyo on this was phenomenal. It was really world class. And you just wonder where it goes. And John, I'm looking at knock-on effects across Asia. I get dollar, yen, euro, yen, but I'm just as interested in Aussie yen or yen Indonesian rupiah. I think there's some real nuances here.
Off the back of the stronger dollar story, TK?
Yeah,
over the last few months.
Well, on a busted theory from Japan. I mean, flat out, it's a busted theory. None of this is in the textbooks. None of it.
I agree with you. They've let it go to something like 0.75% on a 10-year. Clearly, they've got a little bit of appetite to slow that down. But let's see how far that can go, Tom.
Real yield, 2.16%. Here, there's still tension in the air on a Friday. Brown University's got some really cool things. One of them is the Center for Philosophy, Politics, and Economics. They held court at 25 George Street. It's a leafy, perfect building. Looks like it's off a movie set out of revolutionary America. And of course, that leads us to the founding fathers and someone who studies this. Wendy Schiller, director of the Taubman Center for American Politics and Policy, expert on the founding fathers. Let me cut to the chase, Professor Schiller. Would the founding fathers have shut down the government?
No. Hamilton in particular would not have wanted to shut down the government because he believed in the government being an engine of economic stability and grounding for the economy. So no. And, you know, the American public has a less voracious appetite for shutting the government down than they did maybe 10 years ago. 10 years ago, I always argue the Republicans won by shutting the government down in 2013. They did. They won the Senate in 2014. But in 17, 18, Trump sort of ultimately caved after 30, 35 days on that. And then the 18 elections, the 20, the 22 elections haven't been stellar for the Republican Party. So you're seeing more concern among moderate Republicans vocally about a shutdown than you have in previous threatening times about a shutdown. That's an interesting dynamic going into this weekend. You know, the Freedom Caucus, they'll win if they shut the government down for a couple of days to make their point. They get more border security money, and they open the government back up in about a week. You know, does some damage, but they end up, muscling, showing their muscle, and then border security. But it also helps Biden. This is what I don't understand about the Republicans. You're going to waste money with a shutdown, then you're going to get more money for border security, and Biden benefits from that.
Wendy, we had a congressman on yesterday from southeastern Wisconsin, between Chicago and Milwaukee, removed from the politics of grievance. How do we get out of this doom loop of woe is me grievance within the GOP party? How do we extract ourselves from where we are to a better civics?
Honestly, this is where individual figures in American politics matter. Donald Trump matters on this because he's running, B, he's got a lead now in the primary, and his whole politics is grievance. It's personal grievance most of the time for Donald Trump. But in 2016, he ran on national grievance, right? He ran on, there's too much crime. We're all unhappy. The economy isn't as good as it should be. I can fix it. Kept saying, I can fix it. His entire, gestalt, right? A political gestalt is about grievance. So as long as he is a major public figure with a lot of support amongst a slice of the Republican Party, you cannot rid our politics of grievance. It will just be here minimally till November 24th.
In the meantime, when we talk about the potential for a shutdown, there was a Wall Street Journal article outlining how there is a loophole that gives the chief executive, which would be the president, some discretion over how painful the shutdown would be in terms of what gets closed, what remains open. Is there any incentive for President Biden to make it more painful or less painful in terms of allowing passports to get processed, keeping some of the national parks open, things of that nature?
Lisa, that is a really fantastic question. If the election wasn't a year away, yes, he would have some incentive to really inflicting pain, particularly in areas that tend to be more Republican dominated. But since most voters will say, I'm going to a national park, the president runs the country, and now it's closed and my vacation is ruined, they will blame Biden. So I don't think he has the same kind of flexibility right now that maybe past presidents had, given the timetable and the way that voters are sort of dividing the blame right now for whether government's working or not.
Meanwhile, Chris Newsom of California seems to be, Governor Newsom, keeps coming out and acting almost as the defender of President Biden, even as a lot of people wonder whether he's about to run. What do you make of his role in all of this and sort of one of the biggest mouthpieces suddenly for the Democratic Party?
Lisa, I'm not sure Gavin Newsom actually does Biden favors. I mean, I think we can all probably put money down that California will be Democratic in the Electoral College for 2024. And it's just unclear to me how he helps, because California is more liberal than Michigan, Wisconsin, Pennsylvania, Arizona, and Georgia, to say a few. So, to name a few. So I'm just not sure how it helps, but he does help himself, just in case Biden falters or there's some semblance that Biden won't run. I think he is trying to do right by the Democratic Party, but also keep his name out there and be in the public eye. So he thinks it's a win-win. I'm not positive it's a win-win for Joe Biden.
Well, Wendy, what do you think the White House thinks about it?
I think they're annoyed. John, wouldn't you be annoyed? I mean, you don't need anybody else defining the message of the Democratic Party, particularly the governor of a state that is clearly blue. If Gretchen Whitmer wanted to go out there and defend Biden all the time, I think that might be more palatable to Joe Biden. So we'll see. But I think there are, people in the Democratic Party that are saying we have to have a plan B. We have to have some set of people that we can turn to in case Biden falters considerably or for some reason decides not to run.
Is your base case still that he will run?
I think if he's walking, breathing, and talking, he's running. Yeah, I don't think there's any way Joe Biden steps away. And I hope, I wish every politician, good health. I don't want anyone to go anywhere. But I think he believes, A, he's the only one who could definitely beat Trump because he already has, and B, because he has enough experience, he's doing good things for government. As long as he can still do that, he's not going anywhere.
Wendy Schiller of Brown University. Wendy, thank you for the update. Sneak peek of 2024, Tom. All of that's still to come next year.
She's so blunt. If they're walking, talking, breathing, that's your quality.
Is that where the bar is?
We should remind everybody that Professor Schiller has one of the definitive civics textbooks in America. I mean, Gina Raimondo and her, they're on Best Buds.
Didn't know that.
Wendy owns like half of Newport off the royalties of it.
Newport's nice.
Yeah, it is.
Yeah, it's nice. Been there before.
The Black Pearl and the Dockside.
Yeah, sure. Lovely. Okay.
The Landing.
More on Tom's American
Go out
tour
the Landing.
a little bit later. You should do a vacation show. I'd love to see a travel show.
I should.
That'd be very cool.
Newport.
Adam Ruskin at Deutsche Bank. Coming up shortly.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Just waking up, you want the Ryder Cup update? Europe versus the United States. Dan Rappaport of Barstool Sports says go back to bed. Europe crushing it. More on that a little bit later. Equities on the S&P.
Yeah, I'm glad you bring this
Look
up.
like this on the S&P 500. Futures up by 0.5%. We'll do that later. Let's see if the score changes. The Nasdaq up by 0.7%. We are up on the session. We are down on the month. It has been a difficult month of September. First quarterly loss, Tom, potentially for the S&P 500 of the year so far.
Well, it's interesting. We end September, we end the quarter here challenged. I can tell you the tape today summed it up within correlations is better than good off of Wednesday and Thursday. But, John, that's at 6:30 Wall Street time. Where are we going to be at 12 noon? Where are we going to be at 2 p.m. as we go into the close?
Where are we going to be the next time the Fed meets based on these bond market moves? Because they've been absolutely phenomenal. Let's look at them. 2-year, 10-year, 30-year. Things are settling down. Settling down in the last 24 hours. We've backed away from close to 470 on a 10-year, all the way back down to about 454 currently. We're down 3 basis points on the day. The 2-year, just in and around 5% still, 5.037% on a 2-year, also down a couple of basis points down the 2-year. Interesting for Julian Emanuel of Evercore to link the bond market move to the reports out of UAW that they would take, Tom, maybe a 30% pay raise instead of 36 or 40. And he thinks perhaps just closing that spread contributing to a little bit of firmness in the Treasury market as well. I don't know where you stand on that, but that was Julian's view in the last 30 minutes.
I'm not standing pretty much on anything right now. I think there's so many narratives, so many cross currents going on. I look at this, Lisa, and I just say to myself, I'm going to read and think about the optionality that people like Alan Ruskin are giving us.
Well, it just shows us the volatility implied by the lack of understanding of this inflation and how durable it is. If the UAW shifts its stance and suddenly that moves the entire multi-trillion-dollar U.S. bond market, it raises a question about where we are in terms of inflation expectations and understanding.
Tom Parcelli at PGIM was heated yesterday that even with those UAW union wage increases, wages are ebbing. We're getting a disinflationary tendency on an aggregate basis here. Why don't we go under since we got such an esteemed guest?
Well, I wanted to get to foreign exchange first, TK, so let me do that. The euro poised for an 11th week of weakness against the US dollar. Let's see if we can turn that around in today's session. So, Lisa, here we are on the euro against the dollar at 106.11. Earlier in the week, had a look at 104. We've backed away since then. This currency pair is firmer by 0.4%, but so much weaker over the last couple of months.
Have we reached a level, though, where it is poised to strengthen? And that really is a key question for me at a time where we saw inflation data come in favorably for the euro region, come in lower than expected, and yet you're seeing strength in the currency. So this, to me, it really highlights where we are and the difficulty, frankly, for the ECB.
Into the weekend, massive weekend reading, Nomura getting out front, Jordan Rochester questioning, do we need to begin to frame out euro parity? It just is a basic idea. Do we get further weaker euro?
Well, he texted me earlier. The question was parity or 110. Parity or 110. It's like take your pick your poison. right now. And in leading towards the idea that perhaps we belong closer to parity than we do at 110. We're somewhere in between right now. Under surveillance this morning, we're less than 48 hours away from a possible government shutdown. House Speaker Kevin McCarthy struggling to get hardline Republicans to approve a short-term continuing resolution to avoid one. White House staff were told to brace for furloughs, and the Treasury said most IRS services would pause. Elisa, we're getting closer. It's just around the corner.
And the key question here is how long it could potentially last and whether Kevin McCarthy has the role of House Speaker when it is finished. I think that really, to me, influence. They're looking for him to sort of like, you know, kind of herd cats.
Is it that binary? Is it shut down or new speaker?
You know, it's a good question. I don't think that that's the case, but there is this issue where if he brings to the floor a vote, that could potentially alienate some of the people in his party. That said, there might be some measure passed that gives him a pass, sort of a Hail Mary that gets around it.
Right.
But these are the sort of mechanics that people are looking at and saying, it's going to shut down. The key question is how long and what the damage is.
That's the deadline for the weekend. Let's talk about another deadline today. The UAW saying the strike against the big three automakers will expand at noon unless progress is made. Union President Sean Fain expected to give an update on Facebook Live at 10 a.m. According to our reporting here at Bloomberg, the workers are ready to accept a 30% pay raise, down from the initial 40% sought at the start of the strike. So we're closing the gap, TK. Just a little bit more going into this deadline later this morning.
I wonder the other items. That's all. I think you're right. The Facebook call's important. 12 noon's important. Their strategy's original, to say the least. But it's just, to me, it's not just about pay. It's about getting back to some form of pre-collapse in 07, whenever it was.
Step one towards doing that, potentially, Tom. Maybe more tension on the horizon. Want to squeeze this in. Nike shares rising after the company reported earnings that beat estimates. The sportswear giant also reporting a drop in a stockpile of inventory. A sign it's making progress in moving out older merchandise for newer, more profitable items. The stock seems to like the news, that's for sure, Tom. We're up by close to 8% in the pre-market on Nike, 96.61 after some pretty terrible news elsewhere. When you think about what we heard from Dick's Sporting Goods, what we got from Foot Locker, direct-to-consumer when it comes to Nike, maybe a little bit better, Bramo, based on what we've heard from the company after the close yesterday.
And you see the knock-on effects with the Adidas and others that see also their shares popping ahead of the market. But to me,
I heard that and I love it.
Okay, thanks.
No worries.
Okay. I actually am shifting. Tom, I'm not quite to petrol yet or aluminium, but I am in Adidas because I get it. They're a German company.
Thanks.
But what my point was is that as they clear out inventory, there's this feeling that maybe they've got more pricing power. And then that goes to that sort of stickier inflation call as well. Because the direct-to-consumer brands, I know, I'm so young brand.
When we were kids in the UK, we used to call Nike. That was a British thing.
Really? Okay,
yeah.
I'm not
for a long time, we used to say Nike instead of Nike.
That's very funny.
I think I did that for quite a few decades until maybe I moved here. And it was, it's Nike, and Tom, it's up in the pre-market.
Joining us now to save the show, Alan Ruskin, Chief International Strategist at Deutsche Bank. And we're thrilled he could join us this morning because he has an incredible note out on American exceptionalism. Alan, I just love what you say about the good and the bad of where we are. Within this market turmoil, there's that whole feeling on a Friday, wait, we're American, we'll persevere, we'll get through this. Describe how America's different given the bond instability we see.
Tom, look, I think there's plenty of good. A lot of it relates to longer-term growth factors. The U.S. is very competitive in an array of different industries, new and old. The geopolitics, I think, is very helpful as well. In the defense industry, in semiconductors, as just two industries. But on the negative side, and perhaps not focused on all that much until very recently, has been what's been going on in the public sector deficit. And a cyclical -6% or -7%, as far as the eye can see, would not be seen as sustainable for any country other than perhaps the United States.
With the Putin invasion, David Folkerts-Landau is out front on this. Now, we had in America what Olivier Blanchard calls the Biden stimulus, a series of stimuli. And folks, we know we got to the last one and away we went. We don't have that